you get this kind of 500,000 barrel a day cut through the course of next year at the right price. So
well, hold on a
$70
second.
to $80 is the right kind of price levels.
I want to develop that a little bit, Max, because you're talking about a potential 50% price cut. That could be a $40 handle on Brent crude, even $35 on WTI. And this comes, as we heard from Paul Sankey last week, there is this risk that as the U.S. ramps up production and as Saudi Arabia loses market share to the U.S., they'll flood the market. They'll just say, look, you guys are going to do this, let's go. And put all the barrels out there and get prices low enough that people start cutting production. What holds them back from doing that?
Well, I think obviously that kind of price decline will hurt everybody's profits and revenues. I think the stick or the stick that Saudi has is quite effective in the sense that they have the ability to raise production by 20% themselves. So they could offset, for example, on paper, a 20% decline in price with a big increase in their own production. Not many other frankly, very few other OPEC Plus countries have the ability to do that. So in the worst case scenario, it's potentially least painful for Saudi Arabia and more painful for everybody else. So I do think that dynamic makes the stick quite effective. Obviously, if there was a hard landing on the demand side, if non-OPEC supply continued to grow extremely strongly, and on that note, we do have a material slowdown sequentially in US growth in our forecast for the next 12 months. Most of the growth that we have is actually OPEC plus bringing back some barrels and or ramping up over the next 12 months. So if you take that out of the market, if these cuts were extended, you're actually running a deficit in the first quarter if the quotas are met as well, and overall if broadly the quotas are met, because we are assuming some slippage to get our balanced small, 100,000 barrel a day surplus in the first quarter. So it does appear that it's within OPEC Plus's grasp to hold the market together in the baseline. But yeah, look, a hard landing on the demand side, big surprises on the upside on supply, less disruptions than normal. Perhaps OPEC might break. But look, I think you have to get into a pretty dark global growth environment to even think about that.
Which raises this question, are we in a narrower range? You said, there could potentially be some sort of significant downside should production come back online, but you see that as improbable. So are we in a pretty narrow range after a lot of really massive swings over the past couple of years?
Yeah, I mean, certainly we think so. And positioning is extremely low now. The spreads have collapsed, and yet the price is being supported here. It's found some, base here, we think around $75. If anything, a base case is we bounce back over the next month or two. Prices stabilize a little bit here. We think, China's going to roll out a significant easing package, significant as in to stabilize the ship, not significant as in a 10% easing as a share of GDP, but significant enough that the market thinks that China will be fine next year, be able to achieve 4.5–5% GDP growth. There's been some big builds lately that we expect to stop, essentially. We expect a reduction in the builds in inventory that we've seen over the last 3 weeks over the next couple of months. So we are expecting a stabilization in prices from here in the short run.
Max, thank you so much and congratulations. Max Layton is Global Head of Commodities for Citigroup. Lisa, that goes to what I was talking about late last week, was my complete mystery without any wisdom is withered China. And there's Max Layton with the idea, you know what, they're going to stabilize it. It may not be 5, 6, 7% GDP, but the gloom is not there. And I really wonder if that was part of the equity pop last week, is somehow China does better.
Well, at least they don't do as badly, maybe, as some people had expected, because it doesn't seem like they're going to come out with some bazooka to generate that kind of growth. They had deflation, bigger deflation than expected overnight in China. So you start wondering how that's playing into some of the commodity calls that we're seeing as well.
Let's be clear here, folks. Deflation is not disinflation. Those are two very different concepts. We'll touch on that through this week of inflation. Tomorrow, a CPI report, really important, a very dense report. We'll do that at 8:30 with Michael McKee. On the equity markets, Sarah Hunt, next.
The top names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Labor markets have been strong. It's going to be an interesting story when that reverses in the coming year.
You're really not seeing the level of restrictiveness show up yet in the labor markets.
We are still looking for a soft landing, but we do think that recession risks are probably a little bit higher now.
We should all be very humble about recessions. They never happen, right when you expect it.
This says we're not in recession right now, but it's not necessarily an all-clear signal for next year either.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, thank you for being with us on Bloomberg Radio and Bloomberg Television. What a week to begin with. Huge economic stream of data, including the Fed decides on Wednesday, inflation on Tuesday, in market adjustments in December. We're racing to the end of the year, Lisa. That's all there is to it.
I keep going back to 6 straight weekly gains, and how much is this being fueled by just rates going down versus some sense that we're not necessarily going to see any kind of weakness, and that profits are actually going to accelerate after what Gina Martin Adams has been saying has been a profit recession that seems to be turning around.
Jonathan Farrow off today. He's watering his artificial Christmas tree.
You have Christmas tree envy. You always do this.
I do. I have terrible. Right now, I have terrible envy because the tree we have at home is a bit lonely, to say the least. But the tree and man is cranning with the article here at 5 a.m. on Bloomberg Television talking about the outrageous price of Christmas trees in New York City, and that goes to inflation here. It's every itty bitty thing, including the $242 tree that
Okay,
was
there's certain
barely
people
7
have
feet tall.
pretty idiosyncratic inflation. I'll just put that way. I will just note what we are expecting month over month tomorrow with CPI is for a trailing 3-month and 6-month core CPI to actually be the lowest going back to March 2021. So this is the thing, and you talk about this rightly so, cumulative. Well, if a Christmas tree is $400, it feels like it's pretty significant. It also depends on where you get your tree because you can get it for $70 outside of whole paycheck, as you call it, and that's even expensive. So I don't know where you shop for your Christmas trees, and I don't even have a Christmas tree, but just throwing that out there.
We're going to get into this right now before Lisa does the brief, which really goes into the schedule of the week. The schedule of the day is corporate activity. Moments ago and widely anticipated, Occidental Petroleum to buy private Crown Rock. It's a substantial Permian Basin deal of $12 billion. This has been widely anticipated. I don't think you're going to see much movement on price. But Lisa, what I would notice here is the sum of corporate activity over the weekend, including 2 parties going after Macy's, I believe together, which has a certain value on it. And then also the blown up deal of Cigna and Humana with a follow-on share buyback. It seems like something to get our radar up on in the week is corporations dashing to the end of the year.
Things are actually happening, and we've seen this. The capital markets are kind of reopening, sort of, although at valuations that might not make the deal come through, which is what we saw from Cigna and Humana. Maybe it was too expensive, so they're just going to buy back shares. What I think this is interesting, especially because there is some sort of antitrust inquiry into the Exxon Pioneer deal. So there's sort of a question of where regulators will stand on this, given the fact that on one hand, the U.S. is producing record amounts of oil, and that's not a bad thing. On the other hand, this administration has had a focus on trying to prevent companies from getting too big.
Red and green on the screen. Futures at -3, the VIX 13.10. I need a brief just to figure out what I'm doing this week.
Here's what you're doing. Economic data is robust. We're going to be getting CPI tomorrow. The expectation is for it to continue to come in, especially on the core level. Wednesday, we get PPI, Producer Price Index, given the sense that we have seen this outright deflation of goods, and Thursday retail sales as we get a sense of the future of.
And you mentioned China with outright deflation.
Outright deflation, 0.5% deflation in the most recent reading. Central banks, FOMC meeting comes on Wednesday, followed by the ECB, Swiss National Bank, Bank of England, all coming out on Thursday. Curious how much all of these central bankers, really led by Jay Powell of the Federal Reserve, will push back against this idea that they could cut rates simply in response to inflation coming in, even if they don't have any sense of why or a better understanding of inflation after getting it wrong the first time around.
You know, and on radio, we had the graphic up of the 3, and then the Bank of Japan, I believe it's December 19th. To me, they're all very idiosyncratic stories. It's not like they're all on the same page. I just don't buy that.
Well, certainly the Bank of Japan is kind of living in its own world in many ways. Auctions are very much front and focus this week. Today we get a $50 billion auction of 3-year notes at 11:30 a.m. Eastern, $37 billion of 10-year notes coming out at 1 p.m. And tomorrow there is going to be $21 billion of 30-year bonds. To me, you asked a really good question, Tom. Does it matter that yields have come in? Does it matter that yields have, quote unquote, stabilized, at least over the past couple of weeks, a bit more than they had recently? It's a good question, especially given the fact that we don't have any resolution to record sales of debt, a deficit that's only widening, a sense that maybe the Fed's going to cut rates even if inflation just comes in without the pain, raising questions about stickier inflation over the long term. A lot of questions that could potentially create a somewhat volatile moment for 30-year bonds.
The research item of the week came out very late on Sunday. It was at some point where Taylor Swift was cheering on the next Chiefs touchdown. And it was from Edward Yardeni. This is a shocking piece of research where Yardeni extends out his optimism to year-end 2025. I'll read quickly. Rather than raise a 2023 target, we're raising this bull market through 2024 and beyond. Here's the math to get the Standard & Poor's 6,000, Dow equivalent 47,000, I believe it is. It's a huge 41,000, whatever. Ginormous number. $300 per SPX share and a forward PE of 20. 300 times 20 is 6,000, and it's a Dow equivalent 47,000. In shock is Sarah Hunt, Chief Market Strategist at Alpine Sachs & Woods. But you and I, we followed Ed Yardeni for years, and this is what he does within economics and investment. He extends out the x-axis. Do you have the visibility to go out past 4th of July next year?
I think it's tough to have the visibility to go out that far, to be honest. I think it really is going to depend a lot on how we start the beginning of next year. The equity markets got very excited at the end of September and the beginning of October, thinking, you know what, the Fed is done, rates are going to come down, and that's going to solve a lot of problems. I mean, you've got a story on the Bloomberg this morning about how fast rates have to come down because a lot of companies are going to be starting to refinance in 24 and 25. And the question is, even if you started in June, you're not going to start with 2% down. You're going to start, if you start a little bit. I'm not sure we're going to start in June. I think that's a big question. And then you get into the political calendar. So the question of timing becomes an issue. And you still have all these people waiting for lower rates. And that's been very positive for equities.
Dovetail what we heard from Sarah House of Wells Fargo, which is a cautious view on real GDP, with the enthusiasm of corporations are going to move forward, move on to a greater bull market. Can you have a greater bull market if you get subdued economic growth?
I don't think you can, and I think that's the biggest question of 2024 is where growth is going to go, and can earnings really hold up or grow 11% or 12% in 2024 when we have that come down of inflation, where some of the earnings that were higher were because of higher revenues because of inflation. You had this sort of rolling and a rolling global recession or a rolling global slowdown, rolling slowdown in sectors in the U.S. Now China's on the slower end. If they stimulate, is that going to help? Is it enough to change the process of next year, and can we keep margins where they are? I think all these questions are unanswered. So I think that that's it. It's tough to roll into an idea of where earnings are going to be when you don't know the answers to those questions.
With the outlook that you just put out there, it makes me think maybe you're rotating out of stocks and going more into bonds.
I think there's a real place for bonds, and I think the question of how fast rates come down, I mean, a lot of investors are more interested in having more of a balanced portfolio than they were. You've got this goes back to the tension of, are we going back to a pre-financial crisis world where rates can have some sort of meaningful aspect in your portfolio? Where they settle is going to be the question, but we're not going back to zero, and I think the equity markets are getting excited that rates are coming down, and maybe they're coming down a lot further than people expect them to. I don't really know where that answer is yet. I don't think anybody does.
One of your highest convictions this year has been the energy stock trade, and right now we're looking at a sort of surprise decline in price, which is particularly surprising given the disruption that we've seen and the Hamas-Israel war. How much do you still lean into that? Do you still think that oil companies are a good buy here?
So I think the biggest issue for this year has been much bigger supply than anybody was expecting. I think Paul Sankey did a great job talking about that a couple of days ago. The fact that everybody expected more barrels to come off the market, both from Russia and Iran, and the fact that they really didn't, and then other people increased supply. Robust demand has been fairly robust. If you get a really big slowdown, that's going to hit the demand side, so it's tough. But I still think longer term, you've got good dividend yields, and you've got a longer tail on hydrocarbons, and that is going to be meaningful.
I look at the hydrocarbons, I'm like, okay, they had a bad month, they had a bad week. I look at the banks, and I guess we could talk forever about that. All anybody's talking about are these super growers we have with 30, 40, and 50 multiples on them. That's not in the textbooks, is it? Do they do year two? Is the biggest surprise here they just keep going?
I think those kind of multiples are not in the textbook, no, but they really did have fantastic earnings this year, and Cameron Dawson's been quick to point that out, right, like how fast they were growing. The question then becomes, can they keep that up? And if the delta is negative, if I'm growing but I'm growing more slowly.
What do you mean by delta's negative? You mean the rate of change?
If the rate of change is negative, so that I'm growing but I'm growing less fast.
Somebody briefer.
I'm growing less fast. Do I deserve that 30 or 50 multiple? And I don't know the answer to that question because it depends on how fast we grow. I don't see it that fast.
I like that you're just honest about this. And we've seen all these projections about, this is what we expect to happen in 2024. This is what we expect to happen in 2025. And it's almost the curse of having to come out with a full year strategy. But if you had to, what would you be looking at toward the end of next year?
I think one of the things that's been surprising is that with the strength of the labor market, you haven't seen wages increasing as fast as people predicted that they would. So when people say the labor market is still very strong, yes, but wages aren't increasing that much. If we can keep a labor market with an unemployment rate that's fairly low, and I don't know what that number is, and you don't see as much wage acceleration, then that's going to help on the margin side. It's not going to help on the consumer side, right? Because there's a tension to that because people aren't getting paid as much. And you go look at food, inflation may be coming down, but going to the supermarket doesn't feel any better for anybody. And so I think that those are the kinds of things that make it difficult to say spending is going to be completely robust on the consumer side next year.
Can I just say thank you? Because she knows, Sarah knows that I like the smell of pine trees when I walk by, so she got me Pine Tree.
You didn't get those in Pine Tree, Vermont this weekend?
I'm going to share. I'm
You were
going to
there
share
with
with
Bob
you.
and, you know,
we'll light our candles.
The general and
think about what's
she
ahead.
went to a place they did White Christmas this weekend.
I heard.
Saw Rosemary Clooney. You know. So are you going to unwrap them so we can smell the pine? Or?
Yeah, so the audience can smell the pine? Yes, we'll do that.
Yes,
we'll do that in the next episode.
They can smell it on TV, not radio. Sarah Hunt, thank you so much. Alpine, Saxon Woods here. My head's spinning on the equity ballet right now. All I know is I can quote where we are right now, folks. Thank you. 46.58, Standard & Poor's -2 fractional was green on the screen on the Dow. 36,600 on the Dow. Standard & Poor's 500 down fractionally.
Yeah, basically just stable after the 6th straight week of gains. I think it's interesting that we're starting to see, Tom, the increasing merger ballet, as you put it, because it sort of raises this question, is it the beginning of capital markets coming back in a material way? Just because we're getting stability in benchmark yields, all of the deals that didn't get done this year kind of, if you have to do something, it's better to do it now than when yields were 75 basis points higher.
I'm very proud that we covered this, but it's here and it's going to be sustained in that finally money costs something. The real theme, particularly for the back 6 months of this year and in the next year, is this real yield that we quote, 2.02% right now in the 10-year. One way of measuring it. There's many real yields, inflation adjusted yields, but this permeates small business. It permeates everything to do with small caps, mid caps. Maybe that's a small cap discount that we see right now. It costs money to do things. LIFO, FIFO, I haven't quoted in 15, 20 years. And, you know, you wonder, is it a LIFO, FIFO 2024?
Right. Do people actually start to feel the pain of these rates that were supposed to be felt before? We were saying that this was going to be, you know, Armageddon when rates rose. They rose 5%, and nobody seems to care. The companies went along as follows. Does that time run out? Is it just very long lags?
In our world, in the media world, with the rationalizations of digital advertising, but some of it to me is just there's a new cost to doing business, and it is an inflation-adjusted rate that's tangible.
I thought you were going to say Apple stores and going and getting products from everybody.
Oh, no, we'll be doing that this week as well. It's a complete week. It's an Apple week. We'll have to see how that goes with the fan as well. Right now, futures at -2. Yields elevate a little bit. Ferocious week of economic data. We'll talk to Kate Moore of BlackRock in the 8 o'clock hour.
This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
We've
think there needs to be a premium put on protecting civilians and making sure that humanitarian assistance can get to everyone who needs it. And as I said, I think the intent is there, but the results are not always manifesting themselves. Israel needs to be able to deal with this to protect itself, to prevent October 7th from happening again. But as it does that, it's imperative that civilians be protected.
The Secretary of State, Antony Blinken, with CNN over the weekend, urging Israel to do more to protect innocent civilians in Gaza as the story continues. Interesting to hear from the Secretary of Defense. Maybe we'll hear that today as well. John Farrell on deep assignment here before the holidays. Lisa Bramwitz and Tom Keene, an exceptionally busy week. Let's dovetail it into retail sales. We've got Tuesday, CPI, a small matter of a Fed meeting on Wednesday, and then we get the real data, which is 70% of the American economy.
The expectation is for it to actually decline even on an inflation.
It's a nominal statistic, so
right.
if inflation comes down, by definition, it comes down.
This is going to be the key question. Is it coming down just simply because inflation is disinflating, not deflation, although in goods you are seeing deflation, or is it that people are actually just exhausted by paying these higher prices? You talk about the cumulative effect.
Yes.
And do we start to see that play out in just rank and file stores?
I'm really big on the cumulative effect right now. I think it's a huge deal. I've never said that. I mean, this is pandemic-induced, folks, and maybe off the stimulus as well, but I see it anecdotally every day of people thinking in terms of end of 2009, February of 2020.
When my kids start asking me for more money for lunch because they know how much the price has gone up by several dollars,
right,
it gives you a sense of where we're at.
We will have to see. Right now, on the read of the weekend, let me do a market check. Red and green on the screen. I don't know what we're doing. Maybe we'll end up record high here at the end of the day. Who knows? On oil, Max Layton, thank you so much for joining from Citigroup. Oil, $71 a barrel American. Brent crude, $75.55. Great to talk to Citigroup with their call of the year on weaker oil prices. Dollar fractionally, it changed. This is a really important conversation. It comes off my article of the weekend on American politics. Amory Horton, of course, is our Bloomberg Washington correspondent. And there it was, Amory, Michael Scherer, rather, in the Washington Post, writing an absolute tour de force on the fact you're going to only visit like 3 states for the election. They summarize it, only 18% of Americans matter for this election. And it's the ageless thing of the popular vote and the electoral vote and all that. How are Mr. Trump and Mr. Biden adapting to the Michael Scherer article this weekend that so few states, counties, and electoral voters matter?
Well, that's why at Bloomberg, alongside Morning Consult, we have a poll that we've been doing monthly that focuses on 7 swing states. Because when you look at the electoral map, this is where elections are won and lost. You're obviously going to see campaign efforts ramp up when it comes to President Biden. Today, he'll be heading to Pennsylvania. But also when it comes to the former president, who right now has to, of course, get through the Republican primary, even though he is by far out ahead of all the other potential candidates. I mean, you look at the Des Moines Register this morning, 51% of likely caucus goers are going to vote for him, and that's his first choice. This is his highest we've seen in that particular poll. But over the weekend, he was in New York talking about his comment about wanting to be a dictator on day one. So potentially is going to have a little bit more work to do with when it comes to independent voters if he does become the nominee. But that will start to come in focus more so next year.
What's interesting to me, and this is off the Michael Scherer article, and we have our Greg Giroux, who's just absolutely encyclopedic at this. You know that, AMH. The idea here of county by county, what does the president do to get out the vote? Everybody understands Biden's got a redux 2020. How does he do that in Greg Giroux's county by county study?
Well, there's a lot of things. I mean, they're going to be sending out a number of individuals from the campaign that are surrogates for this campaign. They're going to have to figure out how to tap into the youth vote. You know, there was overwhelming support for people that came out in support of Biden, not so much in 2020 because they loved Biden, but also very much there was an anti-Trump vote. Can he ramp up that kind of feeling once again, especially when the former president is dominating in head-to-head matchups against Biden. The Wall Street Journal poll this weekend showed Biden at his lowest of his presidency. And many in polls are saying that they prefer the former president when it comes to economic issues, which rate number one on top of voters' minds when you look at poll after poll, especially given the fact that Americans are still dealing with higher inflation.
So is it inflation, Emery, or are some of the polls protest votes? People who are frustrated with foreign policy right now?
That's an interesting point, Lisa, because what you saw in this Wall Street Journal poll, they had a line talking about a number of individuals who are frustrated with the president, but not sure that they won't vote for him come November. So potentially they're getting a call, they're annoyed, so it's this protest polling, but they'll come back around when it comes to November. We also can't discount abortion as an issue that drives Democrats in campaigning. They spent a fortune on this in Virginia. There was just that ballot poll vote in Ohio on this. Kentucky, deep red state, still has a Democratic governor. Abortion still is a reason why people go out to vote. And I don't think we can discount that because many people said we were going to see a red wave when it came to the midterms. We didn't. And it continues to win elections for Democrats.
So the focus for us has been a lot on foreign policy, Emery, just simply because it has been such a dominant theme internationally for a lot of the allies of the United States and others. I am curious, we're talking about the domestic issues, how much focus there is in D.C. on Vladimir Zelensky coming to Congress this week to plead his case at a time where they're trying to shore up their domestic base heading into next year's election.
Well, you have to imagine for Volodymyr Zelensky, things are looking pretty dire on the ground. Shalonda Young, the director of OMB, put out a note saying that there is no extra pot of money at the end of the year. They will be running out of funds to support Ukraine. So Zelensky, he ditched recently a Zoom call with the Senate, and instead he's going to be making his plea to senators in person tomorrow. So he'll be meeting with the White House, he'll be meeting with senators. He'll also be meeting with Speaker Johnson. This is where the Republicans have a lot of pushback when it comes to Ukraine aid, more so in the House than some of these foreign policy defense hawks in the Senate. So he'll be making that case in person. There'll be a tremendous amount of tension in Washington, D.C. when Zelensky arrives. He'll be arriving today, and a lot of those meetings will be happening today and tomorrow. And this is as they're trying to shore up in the Senate, pulling together a Ukraine aid package that also links to other items like more funding for the U.S. border, and also what Republicans want to see is stricter asylum laws and stricter parole laws.
Anne-Marie Horton, thank you so much. Greatly appreciated this morning. Our Chief Washington correspondent. Look for her work in the afternoon, Balance of Power as well. We are focused on the markets, and we are so with some amazing bull market calls. We've got the shock of Ed Yardeni out 2 years and a month. Forget about that. That's an outlier call. But in the trenches, it's a reaffirmation of bear market calls. Is a general statement, 41, 4,300, 4,400, right now 46.58. And then others that are sort of like, we're going to churn. And then there's the bull market calls like John Stolfus at OPCO that get the headlines. But, you sit there and go, we're going to churn this year. So what do? Go to cash? Do you just go away? I don't know what you do.
What does churn mean, right? Does it mean that basically big tech continues to hold in gains and some of the others catch up? Does it mean that certain stocks win and certain stocks lose, and you can understand it if you understand the rolling recessions that we've seen in different industries? I mean, these are some of the things. What I find fascinating is you could get 4 people with the same economic calls and 4 different views on the market, because that really shows how divorced the actual corporate performance has been, at least in the S&P and NASDAQ, than some of the fundamental drivers of the economy as represented by bank lending, as represented by consumers in the lower deciles of income.
Can we go nerd on a Monday?
You're asking?
I've got the HP 12C out here, folks, a Hewlett-Packard calculator, and on $5.8 billion for Macy's, $5,800 million, they got like 300 stores. So you're buying a store for $19 million each? Is that all Macy's is worth? I mean, Santaland alone is worth $50 million.
Is this your pitch to
this
be
is,
a Santa?
I'm trying. I just think
it's really trying.
Great. $5.8 billion for Macy's. Bloomingdale's. The makeup counter at Bloomingdale's is worth that. Good morning.
the reception, the acceptance of Purosang has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Purosang all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Bloomberg surveillance on television, on radio, on CarPlay, which is extraordinary new technology. Thrilled about that. We'll be talking a lot about that into the new year. Got red and green on the screen. Right now, it's sort of all red. Futures -2. The VIX 13.09. Sort of a edge of quiet off the Friday reports. The market moving, they were. And then we go into an incredibly busy week here. There's no other way to put it. 2.04%, up 4 basis points on the real yield. I guess a little bit of elevated yields. 10-year yield up 5 basis points. I should point out the Bloomberg Financial Conditions Index. We're going to get to the Fed in a moment. And Lisa, I'm not going to go into how they do it. I don't standard deviation study. But here's my scientific analogy. You ready on a Monday?
I'm ready.
It's wicked accommodative.
Well, this is the
wicked.
issue, right? Are they going to push
Boston
back?
Fed.
Thanks. Is that
That's how they do it at the
commentary?
Boston Fed, across from South Station.
So will Fed Chair Powell push back against the wicked accommodation that has been moving in the wrong direction? Ultimately, this is going to be the key question for Wednesday when we hear from him.
We're going to talk about bonds here in a moment, really how it folds into the Fed. Our special coverage on Wednesday, the Fed decides really working towards lining up an eclectic, interesting group to get you through, critically, the press conference. As Chairman Powell he's out front of the others. They all have to follow him.
I think they're probably grateful about that, frankly.
Yeah.
He can set the tone and come up with the sort of word of the day, and they can all say it. Under surveillance this morning, let's get to it. Ukraine's President Zelensky heading to Washington to meet with Biden and congressional leaders tomorrow. Zelensky expected to make an address to U.S. senators in a bid to unlock aid. House Speaker Mike Johnson will also meet the Ukrainian president. I have to wonder how awkward some of those discussions might end up being, Tom, given the fact that Ukraine says it's running out of time, it's running out of money, and there's a lot of twiddling of thumbs and kind of tit for tat having to do with border security and some other issues where things haven't been able to get passed.
My take on this, and I defer to Admiral Stavridis and others, the generals that are with us, is one of the great common features of the American war experiment is we're always sure it's going to be a short war, and it never is. It never is, and in this case, is a distant war in that. I'm not at all surprised there's a raging debate going on.
Well, but at this point,
play out will be interesting.
Some people are saying that Russia has the fiscal upper hand because they have the entire government behind them, whereas the coalition of allies behind Ukraine are faltering in places. UPenn President Liz McGill, the next story, she did resign, the announcement coming just days after being confronted by Congresswoman Elise Stefanik on whether calling for the genocide of Jews is against school policy. Now, the latest is Harvard's Claudine Gay and MIT's Sally Kornbluth, both of whom have come under increased scrutiny since last week's testimony. Harvard graduate and Pershing Square founder Bill Ackman, who's been really vocal on this issue, posting on X, quote, "In her short tenure as president, Claudine Gay has done more damage to the reputation of Harvard University than any individual in nearly 500 years of history."
And my question on this, like everybody else, I saw Saturday Night Live's treatment of this. And Lisa, you've really been in this story. We were so honored to visit Mark Rowan and the people at Apollo, where this theme was front and center. what about another 50 schools or another 200? I mean, Chicago, your University of Chicago is really stuck out for saying we're not going down this path. But is it just about 3 fancy schools? What about the other X number of fancy schools?
Not to get too philosophical, but there has been a raging debate around what does free speech mean and what role universities play in fostering free speech. And what's become clear, what a lot of people agree with, is that there has not been free speech in the definition of many different viewpoints from all sides of the political spectrum being able to be voiced without being shut down. And so this question is, how do you create that culture in universities that have created a different culture for 10 to 15 years? And then you have inconsistent standards, and then this question of which speech gets censored and which doesn't. It is something that comes down to an ability to be uncomfortable in intellectual discourse that I think is sometimes lost.
Yeah, the uncomfortable is the key word there right now. My answer is University of Chicago seems to be getting a claim here. Besides that, when you were at Chicago, did you go see the White Sox or the Cubs? Did you make the trek up north to the Cubs?
I saw the Cubs, yeah.
You saw the Cubs, that's what
It was a great stadium. It was a great experience.
They're going to do an auction process here on refinancing, rebuilding Wrigley Field.
If you want to go to Wrigley Field, join the other people who are going to be traveling. A record 7.5 million people are expected to travel between December 23rd and January 1st, beating the pre-COVID record of 7.3 million in 2019. That's shocking to me. This marks the busiest year-end travel season since the American Automobile Association began tracking in 2000. We keep talking about, whether the consumer can keep spending, and yet when it comes to experiences, when it comes to travel, the answer is yes, they can. And if you try to get an Airbnb in any popular place or a hotel room, you get a sense of just how much that demand is picking up.
And price theory here, speaking of Chicago, is working because prices are lower. As we heard from Helene Becker and others, capacities really come on. And all of a sudden, there's a lot of empty seats, and the prices come down. Maybe not like petrol. Good morning, John. Petrol down 32%, but the answer is the trip to Paris is way down. I mean, there's no other way to put it.
For now.
I don't know about the trip to Poughkeepsie, but the answer is it's way down.
For now. And we'll see whether that continues as some of the demand picks up.
What we're doing here, the calendar is so full this week. We talked to Sarah House of Wells Fargo on inflation. And right now, at least I think it's important here to talk to Megan Graper, Global Co-Head of Debt Capital Markets at Barclays, simply linking what the bond market tells us about what the Fed could or should or will do.
Or when companies are going to refinance. And Megan, that's where I really want to start with you. Megan Graper, Global Co-Head of Debt Capital Markets at Barclays, at a time where people are wondering about this refinancing wall that we're supposed to get this year, we're supposed to get next year, we're supposed to get the year after, and no one really seems to care. Do you see a material maturity wall that suddenly makes the rates that we're seeing in the market something that companies have to actually grapple with in terms of higher financing costs?
Yeah, I mean, it's a great question. I think on the investment grade side, what we're seeing is actually a fairly manageable maturity wall where those towers become a bit more of a concern, I think, is in the loans market and the high yield market more specifically. But, I think it's fair to say no one is in holiday mode yet on the investment grade side of the markets, with the report on Friday really opening the door to one more bout of issuance to close out the year. We're in the middle of some go, no go calls as we speak. But what we're seeing is a number of CFOs and treasurers that are just looking to find opportunistic windows and to take advantage of positive technicals when they arise. In this case, they're trying to get in ahead of CPI, ahead of the Fed, and maybe more importantly, a growing January backlog. But it's largely going to be bank and finance centric. The corporates, I think, are looking at fundamentals that are in very good shape and willing to wait things out, and have given some credibility to the idea of multiple cuts being priced in, and are going to wait for those to come and go before they elect to move forward.
This sort of sets up an interesting dynamic. People have been talking about the great shrinking of public debt markets, and essentially that's what you're seeing in corporations, at the same time that the government debt market is ballooning in terms of size. How much do you see this continuing? That essentially the overall size of high yield and investment grade bond markets continue to contract, a positive for the fundamentals in terms of investing in it, simply because companies don't need to raise more money, and if they can raise money elsewhere, they will.
Yeah, I mean, our call at Barclays is that we're actually going to see reasonably stable investment grade issuance as we look to next year. So it's 3 years in a row of $1.25 trillion of debt issuance. That'll be the third straight year. I think the notable change is likely to be more around the composition of that supply. So if you look at ratings, sector, and tenor, I think we're likely to see a much larger percentage of single A and higher borrowers. We're likely to see an increase in terms of financials in terms of that mix, with spreads near all-time tights. And you're likely to see long-dated supply continue to underwhelm. So I think there'll be a bias to stay short until we get towards the end of this cycle, which may take some time to play out.
And Megan, Gina Martin-Adams of Bloomberg Equities, Bloomberg Intelligence, was a spirited conversation on Friday. They were all looking at the parlor game that you're glued to 24/7, and we're forgetting about the real economy, which you and Lisa just talked about, with debt issuance as well. Are we overemphasizing the Fed game of Wednesday? Are we all addicted to the dots and the polling in the futures where we should be less so?
Yeah, I mean, I've not been overly surprised to see a bit of a Santa rally emerge as we round out this year, in large part because we're entering next year, I think, with a growing sense of optimism. And that's not because we don't expect the economy to slow. I think we definitively do. It's not because we think inflation makes its way to 2% target anytime soon. In fact, our baseline is that we end the year closer to the high twos. I think the risks to the downside are shrinking, but it does then beg the question, as you suggest, are the 4 to 5 cuts baked in actually a response to an economy where the data is actually necessitating an aggressive Fed move? Or is it a reflection of a market that's bullish and re-risking? And I think there's a real case that it's the latter.
So take your legit pro conversation and run it out to Cupertino, California, or 7 other places where they're all under bond. They desperately need to do a deal with Barclays. And the answer is, why aren't the techs issuing bonds right now?
I just think all-in yields feel excessively punitive. I mean, even with a point move lower off the peak, I think there's real buy-in to the idea that rates could move lower over the course of the year. And with maturity towers manageable, the ability to wait that out is more palatable. You can hide out in CP, you can hide out in the very front end of the market without locking in these levels for a pronounced period of time. So.
Sorry, we've been talking about investment grade, and I just want to get this in. I do want to touch on high yield at a time where spreads, the benchmark yield over the yield, extra yield over benchmark rates, has dropped to the lowest going back to April of 2022, the lowest in 18 months. Can this keep going lower?
I think it can. I don't think it will be a one-directional move. You're seeing signs of life. I think there's a real willingness to stay in the upper echelon of the high-yield market at the moment. If you think that we're headed for a soft landing, risk appetites do seem to be coming back into the fold. And so the amount of cash flooding into the credit markets at this point in time to take advantage of renewed carry opportunities is very much there. But I think it'll be a credit selection play next year for high yield, and dispersion will be the name of the game.
Thank you. Maggie Graper, greatly appreciate it this morning with Barclays here on debt and how it folds into Wednesday's Federal Reserve meeting. And not much going on in the tape here. I guess it's not a surprise here into a wall of data starting tomorrow. Dow futures negative 16. The VIX elevated 13.11. Yields are up. 10-year yield is up now 5 basis points, 4.27%. Really not all that elevated off the jobs report on Friday. The real yield was 1.99. It's now 2.05, a back up there to a higher inflation-adjusted yield. $71 West Texas. Brent crude rounded up $76 a barrel. Standard & Poor's 500 down 4. Fractional down 0.1%.
We aren't seeing that much action today, but I will just say, to me, the biggest move and the biggest mystery underpinning a lot of things has been the oil space. And I think it's great that we spoke with Max over at Citi, taking over for Ed Morris, talking about how long this can continue. If you take a look at the Bloomberg Commodities Index, it's at its lowest going back to December of 2021.
Yes, thank you.
And this, to me, is raising questions about, is this some sort of signal about China's economy and the deflation that we're seeing there? Is this just people shifting some of their energy sources? You know, how much is that the issue? How much is this just a souring in demand in places that we haven't seen, and how much is just supply? I don't know the answer to this. And I think that ultimately, as much as people come up with theories, we don't really know. And to me, this is one of the biggest red flags that kind of question how long strength can keep going.
I said on Thursday and Friday that I'm looking here at the Bloomberg Commodity Index, which has a nice weighting in oils down 28%, where a gallon of gas is down 32% from the summer highs of last year. But, you know, technically, I don't know what to make of it other than the broad disinflationary trend of commodities is in place. And I go back to the center tendency of the IMF call, the OECD call, my economic call, your economic call, what the tots are going to do. Everything is hinged around China.
Tots are doing really well, by the way.
They did well this weekend. Yes, I watched.
They're number 2 now.
I watched the highlights. No, they're number 5. They're not that well. But we don't do soccer talk like John does soccer talks.
I think that's an understatement of the year. But I do think it's going to be interesting next year.
Moving on.
Yeah, moving on from football, which we call soccer, and he's rolling.
The answer is China's important. Look in your American evening to Bloomberg on Asia television and Asia radio, always important. On Wednesday, it is Fed Day. We'll speak with Carl Riccadonna of BNP Paribas in about 45 minutes. Stay with us. This is Bloomberg Surveillance.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Americans can rest assured that our banking system is safe. Your deposits are safe. Let me also assure you, we will not stop at this. We'll do whatever is needed. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again, and to protect American jobs and small businesses.
The President of the United States, speaking earlier this year following the downfall of a California shop, Silicon Valley Bank, a roller coaster year for the banks, punctuated by that collapse, and also, of course, J.P. Morgan stepping in to acquire First Republic. I believe that was accretive, as they say in the business. The banks finishing the year strong. KBW Banking Index, dead cat bounce up more than 13% from last month. Joining us right now, Srinath Rajan of Bloomberg Intelligence, Bloomberg News, I should say. Allison Williams scheduled to be with us. We're working on that right now. John Farrell on holiday, and Lisa Abramowitz and Tom Keene for a first real talk here about banking as well. Let's save the banking for Allison Williams and look at the Wall Street banking. The media business is hemorrhaging jobs. Different sectors are cutting. Are you assuming that we're going to see right sizing, as they say, into the new year among major banks?
We saw a lot of it at the top of this year. In January, Goldman Sachs carried out one of its biggest rounds of layoffs. They cut about 3,200 jobs, which that firm hasn't done in a long, long time, and in fact hasn't done something of that higher magnitude or higher than that ever before. So it's pretty much close to the maximum number of jobs it's cut. Right before that, we saw Morgan Stanley take out some cuts. So clearly these banks have been focused on expenses and efficiencies. But in terms of job cuts, especially considering the fact that we've gone through a year which arguably you could call was the trough of the investment banking cycle, the deal-making cycle. It's hard to imagine that they will have to carry out any more large-scale cuts. Yes, they will continue to be laser-focused on expenses, but I just don't see any massive cuts at any of these banks unless they need to deal with more problems. Citigroup is the prime example of that.
Deal with more problems. Elaborate, please, because that's a bank that actually has gained some traction in terms of cuts. They've also performed better than expected on the investment banking unit. Where are the issues?
Let's talk about Citigroup for a second. When you have someone like Jane Fraser, a couple of years into her tenure, you still have a stock that is trading well below price to book. The key metric that investors are looking at is just not up to mark. So she's embarking on a rather challenging process, trying to cut through several management layers, trying to jettison businesses that just don't work and make it a stock that investors can embrace. A few chief executive officers before her have tried, haven't really succeeded. The question remains, how much of a runway does someone like Jane Fraser have?
I was looking at the KBW index, and we're looking at the second straight down year. That is the first time it's happened since 2009. We've seen a real cannibalization from the banking sector toward the private investment firms that we talk to so frequently. I'm curious whether people think of next year as the turnaround year, or this is just sort of the beginning of the utilization, the utility-like sort of aspect of some of these banks.
Fair point on the second straight year of a banking gauge, a banking index being down, but it's extremely important this year to actually drill down into the constituents of that index. When you have someone like JP Morgan Chase, the largest bank in the country, that is up 20% for the year. That's not a typo. JP Morgan is up 20% of the year. That actually tells you a lot of what's going on. And that actually flows through from the regional banking crisis or the West Coast banking crisis that we saw earlier this year. That pressure on regional banks only meant that the biggest banks got stronger. The concern, however, for them is what President Biden referred to, trying to put in place rules that are stronger. The setup heading into 2024 looks like everything would be great for banks. The consumer economy is still doing okay. Wall Street deal making will pick back up, and that's good for these banks. But if they go ahead with these plans to put in place these onerous new restrictions, that could make it a bit of a turnoff for investors.
Yeah, Sri, I have a real issue with this because I go back to an August week in 2007 where the banks had to sort themselves out. And this is baloney. The bottom line is JP Morgan, as you mentioned, up 20% this year, is up some 260%. I'm doing the math quickly here, folks. Don't audit me on this. JP Morgan, back to 2007, is up 260%. And the others sort of eyeballing it, they're up about 40%. When do they start getting scale so they can compete with Fortress Diamond on Park Avenue?
It's proving to be really challenging. Jamie Dimon has built a machine, a juggernaut, that only got fortified further with the ability to do the First Republic deal. In fact, if you remember, across the banking sector, there were a lot of eyebrows raised that JP Morgan could go ahead with a deal like that. But at the time, JP Morgan had the best bid out there, and the government really needed to make sure that this little banking crisis problem did not spread.
The window of this chart, the chart's got too many lines for a Monday morning. The answer is the window of this chart is free money. The free money is over. So when do we get the banking roll-up, round three back to Andrew Jackson, when do we get the banking roll-up simply to compete with JP Morgan?
You will get a banking roll-up, not necessarily to compete with Fortress Diamond. The banking roll-up that you're likely to get is below the top 6, 7, 8. There are way too many banks in this country. There is a realization that there will be a lot of consolidation, but you're not talking about that happening in the top banks. There, you're not expecting a ton more deals, at least in the traditional bank-on-bank sense. You will see a lot more in the next rung, in the rung below that.
I look, Sri, at the global Wall Street bank, and there's a lot of sweat out there. Now, is it the media business which is imploding? Or Lisa, give me another business that's imploding right now. I mean, the retail, Macy's, you know, a small $5 billion as well. When your sources, what are they saying is a strategic to do, not only for these big banks, but the regional banks just below them?
The regional banks will face a challenge, not a crisis, but a challenge for sure. Even though the attention has moved away from them, even though the panic around them has subsided, if you may, they have a challenging business model. They have a challenging business model that is also being challenged by the non-bank lenders out there. There are a lot of people vying for their business, the kind of business that they do, and places where they can make profits. And there are just some structural challenges in what they can do.
I need to review this, Lisa. You know, Citigroup's had a hell of a month, as you mentioned. You led with that. On a 10-to-1 reverse split basis, it's trading at just under $5 per share. I mean, again, I want to take this back. What is it? 16 years. The complete outperformance by one company. And Goldman Sachs is frankly number 2.
This has been a year of the largest winning the most, right? And we've seen that in a lot of industries, whether it's tech, whether it's retail and Amazon, whether it's software and NVIDIA with the AI frenzy over there, or whether it's within the banks. But Sri, I wonder, do lower rates actually help democratize the banking sector, or do they just continue to consolidate strength in JP Morgan as all the others try to catch up with capital market activity?
I'm not sure how much you can look at the rate dynamic to try and establish what the banking sector looks like. To your point about the competitive moat, the situation we're in, if you especially look in the US, say some of the biggest ones like JP Morgan, Bank of America, or I mean, let's just look at the Wall Street activity, Morgan Stanley, Goldman Sachs. These banks are not talking about jettisoning their equities business or their advisory business or their fixed income business. That is a conversation that's being had elsewhere because the cost to compete in these businesses has gone up. New rules will make it harder for others to scale up into their league. So what you'll have is a few really strong banks, even if their profits are challenged and even if their profits have a cap on them because of the new rules, they will still remain dominant. It's the others that will have to have serious conversations about which arm to cut off so that they can survive.
Unfair question. We're probably front running Sri out Thursday. Apple told Goldman Sachs, see ya, right? On the charge card. Who does Apple pick up?
It's a more complicated story, largely because Goldman Sachs has been wanting to get out of it. Apple now wants to give Goldman a way out of it. It's not clear when the two sides will agree to a deal that makes economic sense.
Which is your bank that will pick up the Apple charge card?
We have had our Apple czar, Mark Gurman, actually point out that JP Morgan Chase is not a bad bet. But remember, the deal that Goldman signed with Apple seem to be so well tilted in favor of Apple that it really doesn't make sense in that framework for anyone else to pick it up, which is why Goldman's been stuck with it and for much of the last year has been trying to get out of it. There is no easy taker out there.
Do you take off the rest of the year now? I mean, everybody in banking's taken off. I mean, you slide back into the chair January 10th?
Funnily enough, I was talking to a few senior people yesterday, Sunday evening, Tom Keene, and a lot of them were saying they're going to stick here through the rest of December, which means that I'll have to be
That's just to watch Bloomberg surveillance. Sri Natarajan, thank you so much. We're going to catch up with Allison Williams here in the coming days as well in the broader banking business. Futures at -3, Dow futures -9, VIX 13.1 on a quiet screen. There's no other way to put it. I got yields set higher. The 10-year yield 4.27%. Anticipated. Kate Moore will join us from BlackRock on radio and television. Bloomberg surveillance.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but where it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California in San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
Names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We haven't seen the overall market rise yet, and that's what 24 is going to be about.
We think that tech will continue to outperform.
Big rotation from everything that worked in 2023 to everything that didn't work in 2023.
Investors are going to have to look to some other areas that have been underperforming.
I would suggest that investors need to dig a little bit deeper.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Heading into the most important week of December. Welcome back. This is Bloomberg Surveillance.
Christmas, the
Tom
last week of
Keene,
the
Jonathan
year
Farrow, and Lisa Abramowitz. It absolutely is the most important week of the year, of December at least. On live on Bloomberg Television and Bloomberg Radio. Tom, what's more important this week, CPI or the Fed?
I think retail sales. I think
Really?
the nominal feeling of retail sales, CPI's wicked key, get it. The Fed, always important. Our coverage will be with you 2 p.m., actually 1:30 p.m. that afternoon. But I think retail sales, to get a real handle on GDP from 5% on down, do you believe in the gloom? And there's a lot of people out there pushing against that this morning.
We get CPI tomorrow. Then on Wednesday, we get PPI. And on Thursday, as you say, we do get retail sales. What's your sense that an upside surprise, if it's not as bad as people previously expected, that people have to challenge just how quickly the consumer is actually deteriorating and whether we do have some sort of slowdown taking place?
The market's speaking in droves. You see John Stolfus, who's been a successful bull, ramping it up today to 5,200. The Yardeni call out 24, 25 months. Ed Yardeni getting out to SPX 6,000. Dow 47,000. I mean, these are people getting on board this bull market. And to your great point, there's a lot of people that still aren't convinced.
Well, the slow before the grow, right? This is sort of the question that we were asking with David Balin. David Balin coined this. It wasn't me. We stole that. I stole that. This question of we have to get a slowdown to achieve the disinflation that the Fed wants to see, but that will just set up the seeds of the next cycle of the rally. Is that something that people can buy into now before we even see how much the economy has to slow to achieve that?
I go to Gina Martin Adams. I mentioned this in the last hour. It's about the real economy. Underweighted was we do all the Fed analysis in that, and the real economy for part of America is booming. There's no question about it.
And you have to wonder if gasoline prices are coming down. Is this disinflationary or inflationary, right? Disinflationary, yes, on a headline figure because prices are coming down. But this means that people are essentially going to be getting more money in their pockets at the end of every day, at the end of every week, because they are paying so much less to drive around. I do wonder some of these sort of nodes of uncertainty at a moment where we still do see people spending, to your point, the retail sales figure, that could be kind of a mystery.
My note of uncertainty is the market fairly quiet right now. I mean, oil pretty much on $71 a barrel. Lisa, over to the bond space, and you've got higher yields, 4.28% in the 10-year yield.
And this comes ahead of auctions. Today we get 3-year and 10-year. Tomorrow we get 30-year auctions. A real question about whether, yes, the short term, we can understand that the Fed is going to cut rates at some point next year. Over the longer term, a lot of questions. Meanwhile, crude heading lower just marginally, but still in the $70 range, $71.15 on crude.
I mean, this is no question about that. And again, foreign exchange we barely mentioned. I mean, something as idiosyncratic as Turkish lira being managed weaker is out to 29.00. That's not 30. But that's a huge odd story there. And there's some of those EM stories that are out there. Argentinian peso is unraveled since the election of 10 days ago, but still, I guess, in control. But the dollar, I'm going to call it Midland here and boring at a 104 on DXY.
Well, there are a lot of questions. I'm watching the yen actually more today, just in response to some of the Bloomberg reporting. They're kind of pushing back against this idea. They're going to abandon negative rate policy at their meeting next week.
We're going to have to see. This is a joy. I haven't seen her in ages. Kate Moore joins us now, head of thematic strategy at BlackRock, here to try to get a theme for next year. My head is spinning on the themes. Have you ever seen it like this? And how far can you outlook with confidence or conviction? Are you getting out to March of next year? Or are you with Yardeni where you can actually get out to 2025?
Look, Tom, I think next year is going to be a year of many different phases, kind of like 2023 was. So it's not going to be a set it and forget it from a thematic perspective here. And I think you're going to have to stay on your toes around the macro, around shifts in earnings and shifts in consumption. So I'm actually very excited about having to be more tactical in 2024. That's a much more fun environment than some of what we had over the last decade, which people just bought beta and sat there.
Is cash tactical?
Cash is tactical. There are times where you want to overweight cash in your portfolio and you want to use it when you have a lack of conviction or if you're waiting for incredible data prints. But at this point, we're spending a little bit of our cash in the portfolio and actually putting more money to work because we have more conviction in the direction of the equity market.
So what conviction is that? You think that things are going to actually improve from here?
Yeah, we think the direction is up, especially over the next couple weeks. There's a lot more room for people to put money to work. I think if the data that we're all talking about comes out in a positive way this week, CPI showing a continued disinflationary trend, the Fed indicating they're waiting, perhaps pausing, although I don't expect them to say that they're going to pause. And then the retail sales data that you guys were talking about, which is critically important. Is the consumer healthy? And are they continuing to spend? Of course, we have a Goldilocks issue here where we don't want them to spend too much. But we want to see activity.
Which is the reason why the tactical aspect of this is interesting to me.
Right.
It's sort of a question of, are you betting long term that this Goldilocks is sustainable, or are you betting that it can keep going for another month, maybe even 2, and you might as well ride it while you can?
Well, one of the things we've heard a lot of the sell side say as they put out their reports is, the likelihood of a recession is still high for 2024, and with that may come an earnings recession. Now, of course, there are outliers who are more constructive on the market, but the point I want to make is, the earnings recession has largely happened. We've had rolling industry recessions. I don't think even if in a slower growth environment from an economic perspective, we're likely to see another big hit to earnings. And so I think there's a lot of a great ripe fruit to be plucked next year.
Right. With Kate Moore, of course, and we're going to go CFA level 5 here right now. This from her colleague, Wei Li, writing in the Financial Times today, and this is where I want to go on portfolio activity, portfolio construction for 2024. Wei Li, there is no landing. We are just climbing out of a hole. Higher rates are here to stay. We can expect to see greater dispersion of returns. Seizing the opportunities from this trend requires being dynamic with portfolios. That's what Kate Moore says. Not relying on static exposure to broad asset classes that worked so well during the sustained bull markets of the past. How static is investing in the Magnificent Seven?
I don't think it's static at all. I mean, one of the things people forget to talk about with the Magnificent Seven is that they're not just interesting thematically. These are not just companies that are in the right areas at the right time. They are also companies that did the fundamental work. I know you were talking about layoffs and cost cutting in terms of the financial sector a moment ago, but a lot of these companies went through that tough exercise in the fourth quarter of 2022 and the beginning of 2023. So fundamentally strong and thematically strong. Right. I think they are still fundamentally strong and thematically strong. I don't expect to see the Magnificent Seven crater in 2024.
Let's bring it down to retail, down to 401k.
Yeah.
I've been told I have to be in a target fund or whatever that baloney is, or I have to be in 60-40 because Markowitz told me to be in there. What's the partial derivatives of a standard 60-40 approach right now, given your and Wei Li's view that we need to be dynamic in what we're doing?
Yeah, look, in global allocation, the fund I help to manage, we're modestly overweight beta at this point. But as I said, we're moving a lot beneath the surface, and we've been using our cash opportunistically to add index exposure as we go into year end. And I think that's going to be a continued trend, I think, for a lot of investors. They're going to recognize the data looks pretty good, the boogeyman is no longer here, and that if you don't stay invested in risk assets, you're going to really underperform your peer group.
The boogeyman was supposed to be here this year.
Yeah.
Looking at a 22% gain on the S&P.
Yeah.
I'm looking at 6 straight weeks of gains over the past month and a half. What kind of returns in your portfolio are you looking for, are you targeting in 2024?
Well, obviously, we always want to beat the market in a great risk-adjusted way. I think in terms of expectations for the full S&P return next year, it's kind of hard to say. I don't envy the sell side that has to put out a target. But what I will say is there's likely greater opportunity underneath the surface, much as we saw this year. Certainly, we had the leadership from the mega cap, but outside of the mega cap, you look at something like the S&P 500 software industry group. Most of those companies had outstanding performance, something like up 40%. And people forget that. They get so focused on the top couple names that there's a lot to do underneath the surface.
The reason why I ask what kind of returns you're looking for, I'm looking right now at a NASDAQ return year to date of about 39%, just to give you a sense of just how phenomenal it has been so far this year. The opportunity lost in cash or the opportunity cost of being in longer term bonds gets greater if you are expecting a 10, 15, 20% gain on stocks. It is a lot less if you're expecting a 6, 7, or 8% gain on stocks.
Yeah.
How much bigger is the gain on stocks than just holding and clipping the coupons of some of these bonds that are actually offering you truly yield?
Look, I believe that stocks can outperform and will outperform cash in 2024. But I think the really important part here is that for those of us that manage a global asset allocation portfolio, using bonds, using cash, and using alternative instruments is a key part of our risk management. So it's kind of hard to say we wouldn't want to own any of it and then just dial all into equities as a result.
A minute here.
Yeah.
China's grim. There's no other way to put it. Is that the ultimate global allocation contrary trade forward?
It feels there are less investors spending time on China, but I'll tell you what I've been spending time on, Tom, and I just was in India last week. I think that is a place a lot of global investors have turned their eyes, not just from the growth opportunity, but broadening of the capital markets.
Like what Apple's doing, moving fast.
Absolutely, but there's so much incredible energy there. I was
So
really
what's your
struck.
GDP number at BlackRock on India?
We don't put out an official forecast, but I would
it's
say
just TV. I mean, Larry's not watching.
He might 6.5 to 7% looks pretty good.
On India.
Yeah.
Wow, Lisa, 6.5, 7% versus 3-ish, let's call it.
India's stock market is about to surpass the size of Hong Kong's. Just to give you a sense of just how much you're seeing that sort of diversion.
I think there's a huge amount of opportunity there. I'm not just talking about for the first quarter of 2024, but kind of looking out over the next couple years, which is why we had a group of our senior investors there.
Kate Moore, thank you for joining today. With BlackRock, of course, here, really, really interesting nuances there as we go into this huge week of economics. Right now, quiet tape, SPX down 5, all of 0.1%. I did that quietly.
Thank you, Tom. I appreciate that. Well, I mean, why would anyone trade with any conviction today? I mean, honestly, especially given that we're getting CPI tomorrow, the Fed on Wednesday, and then your retail sales on Thursday that could give another leg upward. It seems like people are more interested in the upside surprise than the downside surprise.
Yeah, I mean, you know, I'm doing some math here. Nishan Kumar out with an important study. I'm just doing this to impress Kate Moore, and I'm going 16.
Crushing it. She looks very impressed.
I'm adding
she looks
on
like
my HP12C for Kate Moore. She's just absolutely stunned. Okay, this is boring. This is the guy that owns the New York Mets, Steve Cohen. Great Bloomberg article today. I'll put it out. Since the pandemic, up 16, up 17, up 9, up 12, up 10. Boring, boring, boring. Guess what? Up 64% since the pandemic. That's how you make money. You do it every year. You don't have a big loss.
Are you talking about Steve Cohen?
Steve Cohen. You don't have a big loss. The Mets had a big loss. That's a different story.
I don't know if they're going to actually win much.
That Ohtani thing worked out, right?
Very much so. I think this idea of being tactical is really interesting. And I think also the idea of the fact that people see more upside than downside to playing around in stocks, even potentially offsetting some of the just sure income from bonds, gives you a sense of how much bullishness there really is out there.
I think underplayed is we have a new cost of money, and I think it was there. OMG went from negative rates to positive. The positive real yield is underplayed sector to sector.
Although the dirty secret is it may have more of a stimulative effect in certain sectors right now than people had ever expected. And it was supposed to be punitive, and it just hasn't been to the same degree in many places. 3
or 5 year. I think it's a huge, huge deal. 8:30, Carl Riccadonna, BNP Paribas. Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
We're
step back and we think about the cumulative inflation, I think that's what a lot of consumers are still feeling. So the fact that you've seen the price level rise close to 20% in just 4 years. So yes, we're seeing inflation slow, but consumers aren't really feeling that right now, and they're still seeing a high level of prices, which is contributing to some of the consumer fatigue that we're starting to see develop and we think will carry on through 2024.
Sarah House, Wells Fargo. This has been great. Our team did a great job over the weekend lining up Sarah House here from Wells Fargo on inflation. We did another focused interview on the Fed as well coming up on Wednesday, and we're going to get to retail here in a moment. But Lisa, quickly here, I mean, it's just like you said, I was making a joke about it. Lisa's 100% correct. Wow, what a week.
And given the fact that people are looking for more reasons to be bullish, not reasons to go scream and hide under a mattress. So this, to me, really gives you a sense of where the bias is after 6 straight weeks of gains.
We're going to do Otani here in a moment, the Dodgers, but first we've got to get to Chuck Grimes, senior retail analyst at Gordon Haskett here. He's given us 5 minutes this morning as he looks at Macy's. Chuck, I was thunderstruck with a $5-6 billion handle. Is that all for Macy's?
Good morning, Tom. Yeah, I mean, it values at around 4 to 4.5 times EBITDA, which does look pretty low when you look at historical deals and takeouts for the retail space, which can really vary anywhere between 6 to 10 times. But I think it's important to keep in mind, more than 60% of Macy's operating income does come from the credit side of the business. So we have to think about that in the context. But it's news. It's not the first time we've seen Macy's go through a takeout. Hudson Bay tried it a few years back. Starboard tried it back in 2015. So we're still gathering news. We're actually hosting a 2-day conference starting this morning. And we're supposed to have Macy's CFO, Adrian Mitchell, scheduled tomorrow. So we'll have some news on this hopefully tomorrow from the company.
We'll check back in with you, Chuck. I am curious, do you think that Macy's would be a more successful company as a private one?
Good question. Macy's evolved the performance they executed flawlessly in the past several years, particularly relative to some of its peers. And even if you rewind back back when say JCPenney was a public company, I mean, Macy's done really well. They've controlled inventory. They've got great banners. So Jeff Gannett's done a great job. I'd be interested to see what the strategy is by these two firms outside of the real estate, which is really the underpinning asset here.
Chuck Grimes, thank you so much. We're going to leave it at that as you get on with your busy day. A little bit of audio challenges. He's with Gordon Haskett as well. It's very important. I want to do one EM thing here right now with Damian Sassower. Bloomberg Business and Sports. Michael Barr, Damian Sassower, and one Scarlett Fu. In his day gig, he is Chief Bankruptcy and Africa Credit Strategist for Bloomberg Intelligence. In your world, what is the significance of Ethiopia so incredibly financially challenged?
Well, it's the 4th African country to default in the last, call it, year and a half. I'm talking, we've seen Sri Lanka, we've seen Ghana, now we have Ethiopia. It's a $33 million coupon payment. They're not going to make it today. So it just adds to kind of all the stress that's being placed upon the IMF and other multilaterals that have to get involved and have to help work some of these economies out of their current situation.
Are the institutions, have they run out of patience? Have they run out of ability to help out?
Tom, I certainly hope not, because other countries like Tunisia, Bolivia, and Pakistan are up next, and something needs to be done. And obviously, we talk about the common framework, but this really all boils back to China. And if you look at what's going on in China, they've got their own issues, right? They're exporting disinflation to the rest of the world, and they've just themselves, their outlook has been downgraded by Moody's just last week, taking down the credit rating outlooks for Alibaba, Tencent, you name it, ICBC, the entire policy banking sector in China. So a lot going on the EM credit side the last few weeks.
I'm curious what the sweat factor is at the IMF, given how much money they could potentially lose, given some of the
people sweat too much
discussion
at the IMF.
around Argentina, especially with Javier Milei coming to power, and this real question about what he can do with the hyperinflation, the dollarization, the cutting of all of the bureaus of the government. Is there a real sense of concern that this could leave a massive hole in the balance sheet of the IMF?
Well, I mean, it already is there for all intents and purposes, Lisa. But I think, what we're talking about is, Milei was just, inaugurated yesterday. You have the presidents from a lot of Latin American as well as Eastern European economies there. I'm thinking Hungary. I'm thinking Chile, Ecuador, Paraguay, Uruguay. The presidents were actually in attendance in Buenos Aires. And the other interesting thing over the weekend, which happened in Argentina, is he announced his central bank chief, which is former J.P. Morgan Deutsche Bank is a proper selection to run the BCRA. So look, things are headed in the right direction, but most importantly, they are going to have to slash public funding, and hard. And I think the pain off the back of it is going to be a real issue that Milei is going to have to contend with.
You raised an interesting question, the idea that Milei is getting the embrace of a lot of countries around the world that might pay into the IMF, actually, rather than, say, China. Are you seeing the coalition of countries, the main ones before China came to the fore, behind IMF, really standing up a little bit more and offsetting the fact that China has been pulling back on the Belt and Road and doesn't seem to be lending quite as much as they used to be?
It's a really, really interesting point. I don't think any of those countries are really going to step up and help Argentina out of its funding mess. What they will do is they'll be supportive of Immerse, which Javier Milei is openly on the record as being supportive of. I'm talking the LATAM trading bloc, right? Not kind of pivoting toward the BRICS, which is the whole China, or even pivoting toward, NATO, whatever. So I think it's all quite interesting in the long run. And so, yeah, it just seems that change is finally upon us in Argentina, and change is a good thing given where we're coming from.
I want to do a segue here from your day job to what you really care about, which is the complete repricing of sports this weekend.
Yes. Yep.
Of $700 million over 10 years. Not so much what's it mean for baseball or obviously for the Dodgers, but with Mr. Ohtani, without question, the best player of multiple generations. What's it mean for all of sports?
Oh my God, such a great question, and I have the great statistic for you. From what I hear, and this is unconfirmed, that $700 million 10-year contract is more than the combined career earnings of Kevin Durant and Steph Curry combined. That is an unbelievable number if you think about it that way. Now, here's the other interesting statistic, because our friends down in Flushing, Stevie Cohen, missed out on this prize. You have to think that 10 years after this contract is finally done, they still owe 3 years left on Bobby Bonilla's contract. So it's kind of interesting from a New York Mets fan where we are today. Unfortunately, they didn't win out on this one, but there's other people out there. Yamamoto, the pitcher who's coming out of Japan, Stevie's going to make a pitch for him. There's plenty of talent out there.
Are they going from $400 million Mookie Betts money up to $700 million because they're going to get it from TV and streamers? They're not going to get it from season ticket holders.
No, they don't need it.
They're not going to get it from merch. Where are they going to get the delta?
Yeah, no, it's got to be media. I mean, look, again, when you own any sports franchise, there's really no P&L or business sense that goes into signing someone for 10 years for $700 million. I mean, it's not really about that, but I think what it is really about is, look, I mean, just the numbers themselves are unbelievable in baseball. And they've got to write the check. And they have the money to do it. I mean, this is the Los Angeles Dodgers we're talking about. They're now the favorites to win the World Series in 2024.
I can't think of another industry where the difference in a couple walks or a couple hits could make the difference between, getting $10 million and $700 million.
He's only going to be a designated. He can't even pitch next year because he needs surgery. So you're paying $70 million next year, right? For a designated hitter. He may not even be able to play the outfield. So it's an unbelievable number. And if you think about it, like, can you reconcile? I'm now paying for a guy, I hired a pitcher/hitter, but I'm only getting the hitter next year. It's madness.
He's getting paid $432,000 per game.
If he possibly sit there.
If he
including
pitches
playoffs.
for 10 years,
He did 182?
20 games.
Okay, fine.
Are you thinking of career change?
No, I can't. I can't get the inside of the plate on an 0-2 pitch like he can.
He's brilliant, though. I mean, to his credit, he deserves to be the highest paid player in Major League Baseball, no question about it. But the number is stupendous.
So this is going to adjust everything that we've got.
Yeah,
there,
and baseball and basketball, NBA. I mean, it's got to.
Did Juan Soto sign too early?
Juan Soto's going to be a free agent after next year. So he gets to go back to the well.
Are the Red Sox involved? Are they going to walk away from everybody this year?
You know better than I. You tell
didn't
me
get any
what
sleep
Fenway
this
Sports is
weekend.
up to.
I called up Julie Swinehart. I said, can we just bid? Can we pretend that we're bidding for some of these people?
Well, yeah, I think they're going to surprise you by the end of the offseason. The Red Sox always do.
Damian Sassar on a Monday. Always good to talk sports with Damian Sassar. Bloomberg Business of Sports. It's really, they get some heavyweights in. They talk to some
What's the business sense behind that, though?
That's my question.
I mean,
How do you pay for $700 million? I don't get it.
I mean, it sounds nice for him.
Somebody's going to write the check. Maybe the same people doing accounting for Disney and Warner Brothers Discovery in L.A. That's working out. Flat futures. We're struggling here with the data check this morning. Red and green on the screen. I guess I can go there. The real yield. That's all Damian Sassauer. Excuse me, Damian Sassauer. Turkish lira. 29.00. Good morning.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning, everyone. Bloomberg Surveillance, a Monday morning before the absolute frenzy of the week. We're going to get to the frenzy of the week here in a moment. John Farrell on assignment. Hey, is he Christmas shop? Is he like starting in his shopping?
He's having a day off. It's well deserved. We're very happy for him.
I don't know if it's well deserved. I wouldn't go that far, but you know, he's off, and that's a good thing. Lisa Bramlett and Tom Keene. We're starting here on a quiet Monday. The tape's like half asleep, which is what you'd expect. Futures at -3. And I'm not half asleep. I think it's fascinating. Actually, the reading this weekend was absolutely extraordinary. Yad Yardeni with a bombshell Sunday evening saying, forget about this, have courage to look out to 2025. Up and away. He called it the roaring 2020s.
What's interesting to me is everyone's looking for reasons to be bullish, not hearing much bearishness.
I agree.
JP Morgan really stands out, 4,200, but everybody else, you can have whatever you want with the slowdown, recession, et cetera. Buy stocks seems to be the message from absolutely everyone. This week, we're going to be looking at a pretty massive one. Today, $50 billion of 3-year and $37 billion of 10-year Treasury auctions. I find that really interesting. Tomorrow, we also get $21 billion of 30-year bonds. Plus, of course, November CPI, the main event on Wednesday, which is the Fed decision, followed by the ECB and Bank of England decisions on Thursday, plus retail sales due out on Thursday as well. And you think, Tom, that that's actually going to be the most important of all?
I think retail sales, 70% of the economy. It's a nominal statistic, I think is a huge deal, maybe giving us a pulse that's out there right now. We're going to get a brief here. Michael McKee holding a committee today, and a panel, I should say, in Philadelphia today on why the Philadelphia Phillies didn't get Ohtani. He joins us right now, our Bloomberg International Economics and Policy correspondent. Mike, in Philadelphia, you're talking seriously retail sales. How retail is America?
Well, retail is 70% basically of the U.S. economy, so it's very important. And the question is, will people keep spending through the holiday season? Consumer spending propped up the third quarter, and we saw the numbers that we got there. It seems to be down a little bit in this quarter, but the question is it just a question of timing?
Right.
Are people going to come back and spend as we get closer to the holidays?
What's the run rate right now of GDP? And with all this economic data, do all those different guesstimates, can they come up here as we get to Friday of this week?
Well, we're at 1.2% according to the Atlanta Fed, and that certainly can come up if people are looking to consumers and or businesses to spend. We'll see what happens with housing. It's actually contributing a little bit to the economy, at least it did in the third quarter. But right now it looks like a slowdown, but not anything that the Fed is going to be worried about.
Mike, we've been debating this all day. Which is going to be the most important event of the week for you? Is it going to be auctions? Is it going to be CPI? Is it going to be retail sales or the Fed?
I think it's going to be two things, Lisa. For the bond market, tomorrow is a really big day because they will try to reprice what they think the Fed will do in 2024 based on what the CPI does. And it's not expected to do a whole lot, tick down just a little bit on a headline basis. But also you've got that 30-year auction. You remember what happened back in November. The 30-year tailed by 5 basis points, a really bad result. Dealers had to take down double what they normally do. So there'll be some questions about the U.S. supply that the bond market is going to have to deal with. And then, of course, on Wednesday, the Fed, it's going to be the dot plot. And following that, the summary of economic projections, because people don't really care so much about what the Fed does on Wednesday, is they want to know how many cuts in 2024 and how soon do they begin.
Have we seen a real tone shift from the Fed that they're not as concerned about more accommodative conditions in markets?
They seem to be. And the interesting thing is that when you look at what it costs to borrow money on the, say, the retail level, the prime rate hasn't changed, auto loan prices rates haven't changed, and credit card rates haven't changed. They haven't gone down. So there's still a lot of restraint on the economy. Real rates are still positive, and so they may not think that this is something they're going to have to worry about unless we see a significant change lower in the markets.
Michael McKee, thank you so much. In Philadelphia for an important conference of the Philadelphia Fed. He'll be with us, of course, with all this important economic data through the week. This is a joy, and it's particularly a mathy joy, because Carl Riccadonna of the aerospace engineering persuasion knows the glide paths that are out there. The glide paths in economics are usually described through adverbs. In a paragraph in his recent report, he really nails this. He's with BNP Paribas and their chief U.S. economist. You nail this strange word sufficiently. We are sufficient. We are getting there. Disinflation is now sufficiently in trend. Describe the sufficiently that Jerome Powell has to confront Wednesday.
Sure. Well, there's a tension there, but on the sufficiently side, we're seeing evidence of sufficiently restrictive monetary policy, in that we're not just seeing disinflation or deflation, important distinction you drew earlier on the program, not just seeing it in energy prices. We've seen that spread into goods prices, which tells us a little bit about supply chain healing, but now importantly, we're seeing it where it really counts, and that means we're seeing it on the service side of the CPI, both in rents, and finally, just in the last couple of months, we're seeing this in what now is being called super core inflation, which is core services, ex housing and shelter costs.
We yearn for an ex-ante, get out front Fed. Baloney, there's no evidence of that since biblical history. They're ex post. How far behind are they going to be when they get the sufficient courage up to accommodate?
Well, I don't think they have the courage just yet, and because the factor in the back of their minds that's haunting them is the mistakes made in the 1970s under Arthur Burns, and that was a Fed that knew what prescription was needed, but lacked the conviction to keep the bitter medicine in place for long enough. And as the Fed's determining whether policy has been restrictive for long enough, I think they think that it's sufficiently restrictive. Now it's just a matter of keeping that policy in place for a sufficiently long time. We'll use those adverbs you highlighted, Tom. And the thing that's haunting them is the fact that wage inflation is not back towards kind of what would be a 2% consistent level for broader inflation. And whether we look at the ECI or last Friday's average hourly earnings numbers, we're simply not moving in the right direction swiftly enough to say, sure thing, let's start accommodating policy sooner.
Why didn't Jay Powell push back more then?
I think he has pushed back in recent comments. He said it was premature to be thinking about the timing of rate cuts with any amount of conviction. So it was a bit of a diplomatic answer, but I think we'll see those kind of hawkish undertones in both the communique and also the press conference later this week. You have to think in the back of your mind, Jerome Powell has been someone very focused on financial conditions. Yeah. Financial conditions have eased tremendously, and that restricts the amount or the degree to which the Fed can pivot towards a more moderate tone. They have to keep some vestige of this tightening bias or hawkish concerns about inflation in place this week.
Let's get away from predicting what they may or may not say or do and talk about the actual economic backdrop. Mm-hmm. There is a question about whether they are going to be late and whether this is going to essentially cause a recession. Whether the bias now to not go to the transitory debacle means that we're going to get a recession just by virtue of them not cutting rates in response to disinflation and to weakness. Is that your base case at this point, just because we are seeing a tightening in financial conditions, we are seeing people start to push back a little bit, and the theory is at this point you could actually start to see higher rates bite in a more meaningful way?
We definitely are seeing higher interest rates bite in a more meaningful way, as you highlight, and I think we'll see that in the retail sales numbers on Thursday. We're looking for about a 0.5 decline at the headline in retail sales. Now, part of that is lower energy prices and whatnot, but if you pay attention to what's happening to consumers, the excess savings story is largely washed out for lower and middle income households. At the same time, higher rates, we may have come off of the peaks on 10-year yields and whatnot, but if you look at what households are diverting towards interest payments, so yes, most households locked in those low mortgage rates during the pandemic, but if you look at everything else, whether it's car loans or HELOCs or credit cards or whatnot, the interest coverage for those is increasing pretty appreciably. That tells you that Fed policy is still kind of working its way through the system, and we haven't felt peak restriction. Now, in terms of getting the pivot right, monetary policy acts with a long and variable lag. That lag's probably 12 months, and that means it's going to be very hard to kind of stick the landing. So
sounds like he's from Chicago.
Maybe not recession. Maybe not recession next year, but I think the landing could be bumpier than people are anticipating at the moment.
Bumpier from a GDP basis or bumpier from rates? Because what's in the zeitgeist this weekend is, yeah, they're going to come down, disinflation. Oops, we reverse and we have a reflation.
Well, that's the scenario they want to avoid, and the evidence pointing in that direction would be those sticky wage pressures that haven't improved yet. I think
it's just all about the job market.
It's about the job market, but also the inflation numbers, and we've gotten used to this very immaculate disinflation over the course of Q3 and the early parts of Q4. I think that the inflation is going to look a lot less immaculate in Q1. In other words, Q1 could look a bit like the mirror image of Q3 of last year, and that we see slower growth and more persistent inflation pressures. I'm not saying that the trend is reversing. It's still moving broadly lower, but I think over the last few months it looked more like 2%-ish inflation, and I think it'll look more 3%-ish over the next few months.
A slowdown is sort of the perfect scenario that a lot of people are looking for who are bullish on risk assets. Is that basically what you're pointing to? Is just a pause to allow things to cool, and then everybody can get going again, which is essentially the bull case that we keep hearing from Ed Yardeni and others?
We need slower growth to continue to rein in those imbalances in the economy and in turn the wage pressure story. And for that to play out perfectly in the first half of the year, I think is a possible scenario, but not necessarily the most plausible scenario. So I think there will be some tough sledding, some bumpiness there as the Fed makes it clear that we're not we're not free and clear yet to start reducing interest rates as swiftly as maybe market participants think. And I think we'll see some imbalances in the labor market, some challenges on the growth front. And as you think about the overall earnings trajectory, right, it's ultimately a function of top-line growth and pricing power. And if you're talking about a moderating pace of economic activity and cooling inflation pressures, that's still a challenging dynamic for earnings.
This was a sufficiently good interview. Carl Riccadonna, thank you so much as BNP at Paribas. So I've always gone nuts about the sufficiently thing in economics. I just think it's just an adverb soup. Trying to get around a clarity here. The clarity is futures -4. I don't know. I guess we wait for CPI, and Carl said it's a big deal.
CPI is a big deal.
It's
so
a
is
huge
retail
deal
sales.
tomorrow.
So
as
is
well.
the Fed, and so are the auctions. The auctions are also really significant. I'm watching those.
And I go back to, do I know anything that's gone down in price? The answer is no. Futures in -4. Dow futures down 1/10%.
I think that's the S&P futures down to 10%.
Excuse me, S&P, yeah.
It's just basically the Dow is,
I'm just on
focused.
Yardeni's 47,000. I can't get there. I mean, Yardeni's call is mind-blowing.
What's mind-blowing to me is being able to extrapolate out more than 1 year to 2 years to 3 years at a time where there have been these different economies moving at different paces. And just to understand, sufficiently restrictive is sort of this vague term on purpose because we don't know what the neutral rate is. We don't know where this economy actually is running. We're going to continue that conversation because honestly, in addition to the auctions, this is one of the big question marks underpinning the bond market, if nothing else. Coming up on the open, we've got Robert Tipp of PGIM Fixed Income, Joanne Feeney of Advisors Capital Management, and Mike Wilson of Morgan Stanley, who really maintains his tepid feeling towards stocks despite all the bullishness we've been talking about today.
It's an eclectic brief here before CPI tomorrow. I mean, it's going to be really, really interesting as well. I just go back to the over-analysis of inflation dynamics off the pandemic, and the real question is how far beyond the pandemic are we? Are we back to normal? And I'm still not there. Anecdotally, I'm just a part of the country's benefiting from the stimulus as Mr. Riccadonna mentioned, half the economy's flat on its back.
And I would argue that one way to see exactly what you're saying is that just now, in 2024, there are more memos going out from CEOs saying, you are coming in 3 days a week, now come in 4 days a week, and if you stay home all the time, it's not going to work for us. We're hearing that more and more. Things are reverting back.
The modern economy, the 10-year yield, 4.27%, up a solid 5 basis points. Higher yields, the real yield, 2.04% as well. That's a shock from a year ago, to say the least. An exceptional economic week. Bloomberg's surveillance.
The reception, the acceptance of Purosangho has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Purosangho all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The low to middle income consumer is battered right now by higher interest rates. Even though inflation's moderating, it's still a higher price than it was in the past. And even you take a look at the luxury consumer, you need the feel-good factor. With the geopolitical issues going on, the macro headwinds out there, and the volatility of the stock market, it makes it more challenging. Give them something innovative, they'll be there.
Dana Telsey, expert at American Luxury with Telsey Advisory Group, with all of her heritage, with a luxury that we see in New York City and frankly from coast to coast, is, well, really, really nuanced there on some of the huge challenges of the different parts of luxury. Some of it, I think, is a generalization flat on its back. A busy week of economics here. Futures at -4, the VIX 13.10. We have all very interesting economics tomorrow. The CPI report at 8:30. On to the Fed. We will do the Fed decides on Wednesday and finish on Thursday with retail sales really into the holiday week. A number of days ago, and I did mention this, Tara Patel and Angelina Rascowé out of Paris did an absolute tour de force on luxury, this strange, aspirational business of what we do spend, what we desire to spend, or someday maybe sort of kind of like, I'm going to spend that on these expensive luxury goods. We are so advantaged at Bloomberg to have Deborah Aitken with us. She's Senior Luxury Goods, Beauty and Home Care Analyst, that's a title, at Bloomberg Intelligence, and we're thrilled she could join us again this morning. Deborah, to begin with, partition how small super luxury is among retail sales. To me, it's paper thin, but is it bigger than I think?
The full luxury market, we're looking at $300 billion. And when we look at the super high end, we look at around that being around 10 to 15% within 2 years.
If it's 10 to 15%, the idea is, I guess, the others aspire to catch up. Are they like the big banks where they're lonely at the top, or are there people that can merge to join the super luxury?
I think the thing with luxury goods is that the products that are at the top are generally the brands that are owned within a portfolio where there are entry-level brands, mid-level brands, and very high-level brands owned by the same owner, basically. So it's a transition, and what we've seen over the last decade are luxury brands which are continually moving to build their equity.
Well, I look at what LVMH is doing, and I understand what the Arnault families are doing, but what is perceived by the Bloomberg surveillance audience, these are very, very expensive stocks. They're trading at 25, 30 times, some of them even at 40 or more times earnings. How do you justify that as a shareholder today?
We've certainly seen a trade down in the last year. You can pick up some of these very big stocks just over 20 times. And how you justify that in a way where we look versus history is that if I think about from closure through 2021, we saw full recovery of these luxury goods in 2021, then delivering 11% growth in 22, 8% growth in 23, and that's from a very strong first half, but some downturn in the second half. And that has been pulled from the lower end entry-level brands more than the high end. And on the back of that, what they do on the top line, they tend to at least do on the bottom line because they're very good at managing margin and passing through price.
Where are they on inventory right now? The articles in the New York press are that they're up to their eyeballs in luxury inventory. Do they have large inventory, and do they clear it through price reductions?
So for the very high end, we have a note out looking at consensus as well through the next couple of years. They're on 276 days, and that doesn't go down much. And we say even with digital now being 15 to 20% of mix,
that needs to come back down by 7 to 10%. The best in class manage that. They've been in this predicament before and they've managed through on a couple of occasions. Digital helps that. Talking to consumers, AI, specialist data, that all helps this sector.
Do they want to be in the stores in New York today, 2 entities to take out Macy's for a shockingly small number at $6 billion, a little bit below that as well? Now, I'm going to assume super fancy luxury doesn't want to be in Macy's, but Macy's owns Bloomingdale's. Do these names that we know, Gucci, the rest of them, Chanel, do they want to be in Bloomingdale's?
They all have a position. I think the problem has been for department stores over the last few years. They're working on a much lower margin and they're not as reinforced when it comes to reinvigoration and style within the stores. We've ended up with too many shop-in-shops, but yes, there is a place for most of the luxury within those stores, excluding a few names which will be ultra-high exclusive and won't want them to be there.
I mean, I know you don't do buy, hold, sell at Bloomberg Intelligence, but what's fascinating, Macy's folks up 15% this morning. Deborah Aiken, what I think is fascinating here is what is the opportunity forward? You don't do buy, hold, sell, but are you looking at luxury as the mother of all opportunities with this post-COVID pullback?
I think certainly we have a difficult year in 2024. We're looking at normalized growth, 5 to 6%, and you drag that down to the bottom end to maybe a little bit more depending on how strongly China comes back in the second half of the year. But what you do have into 25 and 26, we think, are a return to higher growth rates and that there's so much to do. Because when we look at these companies, they're so cash rich, so cash generative. They've been investing through this last 18 months and they'll continue to do so in the year ahead. And that pulls this sector way above many others when it comes to driving via top line growth to push the bottom line.
Well, to Angelina Rascoi's wonderful Hermes article in the Dumas family and all that, are these companies so private, so family run, that there's no real discussion about deploying that cash back to shareholders?
The first thing that they're doing, because they see themselves as not yet fully global, so the investment is within new stores. Many of these sectors, these companies within the sector are pushing new store progress and also new collaboration, new design, finding ways with e-commerce and others. There's only a 2% dividend yield on this sector and not many companies are pushing share buyback. With Hermes, for example, in order to drive 10 to 12% growth per year, if we look over the last 5 years, they've had to increase their factory out of France, factory manufacturing facilities by 1 to 2 factories per year. So that really plays to how you get your return. It's a return on investment which is paying off for Hermes.
It's a return on labor. Where do they get the labor? I think one of the great things for our audiences here on radio and television is how do they make all this stuff? I mean, where does the labor come from for the luxury that's out there that's such a premium price and a premium equity valuation?
If we use Hermes as an example, and maybe a couple of the brands within watches too, it's about training artisans, which can take over a decade. So it's built into the highest quality product, really as a you're focusing your lifetime into these brands, and that is how it's done. So if you think about Hermes in some of these past years, they could have grown 20, 25, 30% if they'd have so wished to. But it's about restricting supply, actually, to really evolve and nurture and manage the brand equity and the elevation of the brand for the long term.
This has been just a fabulous brief. Deborah Aiken, thank you so much. Really driving all of our retail effort here at Bloomberg Intelligence. Truly expert on this, and I can't say enough again about the Angelina Rascouret article 2 days ago, I believe. I put it out on Twitter. I'll do it again. Just absolutely extraordinary on just one snapshot of the luxury business and how these families work with it to keep us in chips during the holiday season. Just extraordinary. And you've seen a pullback in some of these prices as well, as Deborah Aiken mentions as well. I want to draw your attention here as we finish out the hour to arguably the conversation of the day. We made a big splash this morning of Ed Yardeni looking out 25 months to Standard & Poor's 6,000, Dow 47. A big splash of the bull John Stolfus at OPCO. Mr. Stolfus reaffirming a higher level, 5,200 now, the end of 2024. But what about those more cautious? Lisa Bramlett's in for John Farrow. We'll have, without question, your equity conversation of the day. Michael Wilson with Morgan Stanley, their chief U.S. equity strategist. Mike Wilson here, recalibrating a caution on a market that just won't pull back. It'll be interesting to see how that market does into a loaded economic week as well. Please stay with us on Bloomberg Radio, Bloomberg Television. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. A soggy start to a week. After 6 straight weeks of gains, the countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up, investors bracing for a big week ahead. A host of global rate decisions on deck, challenging stocks on their longest winning streak since 2019. We begin with the big issue, the last big week of the year.
Looking at that data,
the data coming out,
we have CPI data.
Headline CPI tomorrow.
The inflation numbers will support that the Fed can back off.
We have FOMC meeting.
What the Fed does clearly is critical.
Powell's messaging will be consistent.
He's going to toe the same line and try to push back on the significant easing of financial conditions.
The dot plots are going to be the most meaningful takeaway.
That's probably one data point that all eyes will be on.
We'll be watching the retail sales.
Retail sales will be very keenly watched as well.
It does look still as if the consumer is a group that you wouldn't want to bet against.
I expect that's going to be quite impressive.
As we make our way to the end of the year.
This is a market that is on edge and will remain on edge and remain very much data dependent.
Joining us now to discuss is PGIM's Robert Tipp and Joanne Feeney of Advisors Capital Management. Well, the soup of potential events that are on the horizon. Joanne, I want to start with you. What's the most important one?
Well, the upcoming inflation data, I think, is going to be pretty closely watched. Obviously, that's the big bet right now. Can the Fed afford to pull back on current levels of past rate increases? We don't think they can. We think it's going to be a pretty long slog till inflation goes from current levels, which are not terrible, but all the way down to 2%. We think that's going to be a hard pull, and we don't think the Fed is going to blink, even if inflation does continue to slow. We think there's a long way to go here.
Robert, what about for you?
Yeah, I'm going to angle away from the data. I mean, I know that's where the focus is for everybody, but I think there's a wide landing path, somewhere in between soft landing, weak growth, a little bit above target inflation. It's a good economic backdrop. So I think the markets have priced to pretty steep cuts in rates. The big test, the big focus for me is going to be the supply. I mean, they're issuing today, the U.S. Treasury, almost $250 billion worth of notes, bills today alone. The bills, they'll be issuing 2 times today, 3s and 10s, 3-year and 10-year notes they'll be issuing today. That's a huge test for the market. So is the market's conviction that this is a soft landing and that there will be aggressive rate cuts, is it incredibly strong? We're going to find that out, I think, as a result of the supply as much as anything else.
That's like music to my ears. I spend literally my entire mornings trying to convince Tom Keene to care about the bond auctions and why they're getting more and more important. Robert, just to stay on that for a minute, what are you looking for? What do you think the potential biggest surprise is behind some of the supply and the way it's received, especially heading into the 30-year auction tomorrow?
Yeah, I mean, we'll just have to see how it goes. It's always a wild card, whether people show up or not. Incredibly difficult to handicap. The one thing we do know is there will not be a failed auction. All of the dealers are required to show up and to bid proportionately. But beyond that, it's incredibly difficult to know how well markets are set up or not. But I think the data that we're going to get this week is going to be largely reflective of soft landing or maybe a little bit above target inflation. But I think underlying trends for inflation are extremely favorable, if not below target on some of the key elements. And last week's jobs were firm, and I think the retail sales, there's the potential for upside surprise there given where expectations are. So I think it should be, pretty wide path for pretty smooth landing. I think, though, that we could have some upward adjustment in rates given the rally that we've seen, the aggressive pricing of cuts, and some of the upside risk in some of the data.
We'll dig into that in a little bit, but Joanne, from your vantage point, how focused are you on these auctions, on the supply, and the question mark about who's going to show up?
Lisa, I think in the short term that those matter quite a lot, right? Clearly that market has to clear, and the rates are going to adjust, and we saw that not long ago with the new issues that came out and really disturbed the bond market. But longer term, for equity investors, I think this is really a sideshow. What we certainly care about, though, is the long-term levels of government debt, not just in the U.S., but around the world. That clearly creates pressure on real interest rates. And we're seeing that, I think, in the data over the last few years as debt levels have come up, real interest rates longer term have come up. We think that's going to keep them elevated. That is a relevant issue for equity investors. But what we also see is it's likely the case that long-term interest rates don't go much higher from here, because on a nominal level, inflation is going to come down, we believe, and that's going to put downward pressure on those interest rates. And for an equity investor, the valuation impact of having more rate increases behind us than in front of us is a positive environment for the equity investor.
Do you agree with that, Rob, that basically we're not going to retest the 5% on the 10-year that we saw about a month ago, that we're basically going to head lower or range-bound from here?
I do agree. I think it's unlikely that we're going to test that. I think the data has moderated pretty convincingly. I think there's going to be disorientation, though, among investors. If you think about it, before the pandemic, we had a 2% 10-year note. We had inflation below target. We had a Fed cutting interest rates with very low unemployment. We're an incredible distance from that environment. Now, I would hope the Fed does not want to exercise the option to cut rates just because inflation is a bit below target. I would think that for the U.S. economy's sake, we're much better off, all else equal, with higher interest rates in order to generate savings. But that is an outcome that's out there in the probability spectrum for the market. I think, though, we have just seen a big rally from the 5% area all the way down through the 4s into the 4.25 zone. That was an area that was attractive. It looked like it might be the top end of the range until August, September of this year for an entire year. So I think we're probably back in the meat of the probability distribution here. The mean for that may be lower than people expect. I think people were impacted by seeing the 5% rates, by seeing the high 4s. I don't think we're going to be seeing a lot of that. I think investors realize that over the long term, getting this level of yields in the market, in the bond market, in a diversified portfolio, getting yields up towards 5% when you include credit products and whatnot, that's pretty attractive point strategically. So I think while people are expecting a big move up or more likely down, it is going to be much more of a range-bound market. It's going to be very productive for the bond market.
Which is the reason why I think a lot of people with retirement funds are looking to capture some of that. Meanwhile, investors are bracing for a busy week ahead, as we've been talking about. The latest U.S. CPI print, a Fed decision, and retail sales data all in the pipeline. Joining us with more is Bloomberg's Michael McKee. Mike, what are you most focused on?
Well, there's an awful lot that is going to affect the markets. I think Tuesday CPI is something that's going to get everybody's attention. And Lisa, you're absolutely right. The bond auctions are going to be very important for setting expectations for the future. Remember the big tail on the last 30-year and the fact that dealers had to take down twice as much as usual. And this is before the Treasury raises the auction sizes one more time. That's what they said they're likely to do. The Fed decision Wednesday, pretty much already decided, but we're going to be watching the SEP and the dot plot. And then, of course, retail investors probably looking at retail sales because it's going to give us some idea of profitability. Remember, those are nominal dollars, though, so gasoline prices may push down the headline. And obviously, if you're trading internationally, you're looking at the ECB and the BOE. The Fed is going to be the big deal, even if they don't do something, because they do produce the SEP and the dot plot. And here's what Jay Powell says about it. It's all about inflation. We'll keep policy restrictive until we're confident inflation's on a sustainable path down to 2%. The question of rate cuts just doesn't come up because it's so important to get that first question as close to right as you can. So it's going to be all about inflation for the Fed. That'll elevate that CPI and PPI report week information. And then the SEP, Jay Powell told me, of course, at the last press conference, the forecast decays over the 3 months since they made it. Take a look at what they said back in September, the last time they put out a forecast, and where we are today. Growth is faster. I use third quarter over third quarter since we're not in we don't have the fourth quarter data yet. But unemployment, PCE core, all lower than the Fed forecast and all pointing in the direction of them being done. It's going to be very interesting to see, Lisa, what they set us up for the next couple of months when they release that information on Wednesday.
Especially if people believe we can continue with immaculate disinflation. Michael McKee, thank you so much. Still with us is Robert Tipp and Joanne Feeney. Joanne, from your vantage point, I'd be very curious to see where you think we are in this business cycle, especially as the Fed seems to be done with rate hikes.
Yeah, Lisa, you know, I think it's been pretty amazing what the U.S. economy has accomplished over the last couple of years. I mean, through the pandemic, shortages of supplies, where are we now? Right now, we're at levels of employment that we did not expect to be able to achieve, and that has come about because of higher labor force participation, particularly among women, that we didn't expect. And I think that is what supported the consumer. Not just did they have a lot of savings that they had accumulated over the course of the pandemic, the worst of it, but also there are more of them employed. And that's really what has supported the level of spending and the ability of the consumer to absorb the higher prices that have emerged out of both strong demand and shortage of supply. So when you ask, where are we in the macro sense, the fundamentals are very solid. The consumer is strong. We worry a little bit that things could change because of higher interest rates, impinging project finance or durable goods purchases of households, but we're just not seeing it. And what we are seeing, though, is a story of two different price levels. Goods prices, notice, have actually been dropping, whereas service prices have continued to show that inflation. And so that really tells us about where the spending is among the consumer. So as provided the consumer remains strong in terms of employment, and wages continue to go up, but moderately so, it's really hard to forecast over the visible horizon that a recession might come. It just doesn't seem likely at this point, given the strength of the labor market. And that creates a very positive environment for the equity investor, who should be focused on that longer term, beyond the horizon investing.
So it sounds like maybe mid-cycle, but not end cycle. Rob, do you agree? I mean, is that sort of where you're at, is that we're not at the end cycle, we're not even late cycle, that we're actually maybe even beginning or mid?
Yeah, I think we have a long way to go. I think the thing that people have missed from a year ago is that cycles can be very long and that these central bankers are incredibly flexible. And I think, if you want to get the maestro moniker, working for you as a central banker, when you get up there at the podium, you have to watch what's going on stage. It doesn't matter what's written in the program. And they will respond to the economy as appropriate. They thought it was too hot. They were raising rates. Now things are going their way. They want to make sure financial conditions remain supportive of that. So I think they will be very careful. Here, they're not going to have a dovish bias because conditions have eased ahead of them, but they're going to keep conditions appropriate to sustain an expansion. And the factor that's really sustaining this expansion is job growth and a lack of problems. A lot of expansions sow the seeds of their own destruction through a lot of extension of debt. This one, there are problems in lower quality debt, leveraged loans, and some of the consumer areas, but by and large, the debt markets are in good shape. Credit quality is in good shape. You don't have the problems that bring the downfall, number one, and number two, that labor force is growing a lot.
Yeah.
A lot of this is foreign-born workers, so I think the Fed is going to be able to sustain a very long expansion here.
Robert Tipp, Joanne Feeney, we'll continue this conversation. Both of you sticking with us. Joining us now with a look at the stocks moving ahead of the opening bell. Here's Abigail Doolittle.
Well, Lisa, we do have a few big stock stories to take a look at this morning, starting out with the shares of Macy's. They are soaring up about 15%. This, of course, is the department store operator received a $5.8 billion bid from Arkhouse Management and Brigade Capital Management, making the bet, perhaps, that this company will be able to execute a turnaround better as a private firm. Cigna also soaring up 13%, at least the best day in 2 years, probably much more than that, as they've called off their deal with Humana. They couldn't agree on terms. In the meantime, they're planning on a $10 billion buyback. Investors clearly like that. And also there's now the execution risk, potential execution risk of that big deal, if it had happened, is off the back of that stock as well. And then finally, Alphabet down 1.3%. This is a jury is set to weigh whether they broke antitrust laws relative to its App Store. Epic Games alleges that they've used billions to quote unquote bribe and block its Android partners and developers from using alternatives to Play Store. The stock is down more than 1%.
Abby, thank you so much. Coming up, investors bracing for a busy week of rate decisions.
That's something that we'll be looking at the Fed for clues at their meeting this week is what's the speed of that disinflation that they can live with and what's still not fast enough.
The Bank of Japan making waves as the ECB and the Bank of England prepare to unveil their last rate decisions of the year. That conversation coming up next.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Policymakers, I think they are looking very much more at some of the short-term trends in inflation, so focusing on, not just what we're going to see in terms of headline CPI tomorrow and the month-over-month changes in the core. And that's something that we'll be looking at the Fed for clues at their meeting this week is what's the speed of that disinflation that they can live with and what's still not fast enough.
Global central banks approaching their final decisions of the year. The Fed's rate decision coming Wednesday before the ECB and Bank of England Thursday, all ahead of the Bank of Japan on December 19th. Bank of Japan officials seeing a little need to scrap the bank's negative interest rate, according to a reporting saying they have yet to see enough wage growth to support sustainable inflation. Let's get right now to our team coverage. Bloomberg's Cameron Kreis and Katie Greifeld joining us now for more. Katie, I want to start with you. All of these central bank decisions this week before the Bank of Japan next week.
Yeah, and let's start with Wednesday because that's when the Fed kicks us off. Now, from all three, really, you can expect similar things. First of all, of course, all three expected to stay on hold, and a similar theme among all three, according to BMO this morning. You can expect to see markets again pricing in rate cuts, and all three of policymakers at these banks really pushing back against that. When you look at the Fed, for example, you can see that there are about 4 to 5 rate cuts priced into the Fed next year, even though policymakers from Jerome Powell down have insisted that they intend to stay on hold. There's more work to do to get inflation sustainably back on the path to 2%. So that, of course, is going to add extra focus not only on the press conference, of course, but also on the dot plot. The Fed hates talking about it, and we love looking at it. We'll get fresh projections on Wednesday, and the big question will be what happens to the 2024 dot, whether it will keep 50 basis points of rate cuts that were signaled at September's meeting, or whether or not we see maybe some taken out or maybe some added in. That is the big question. Before we get there, though, we have to get through tomorrow's CPI print, and we'll see how pricing change on the heels of that.
And when we get through all of that, we'll get to the Bank of Japan next week. Cameron, what are we expecting?
Pretty much nothing. It's been one of the market's favorite vectors of speculation as to when the BOJ will move. There were some comments from top-level BOJ officials, including the governor, last week that led people to think that they might actually move away from negative interest rates this month. Our reporting has sort of quashed that suggestion, with the focus remaining on wage growth in Japan, which is pretty much where it's been over the last year or two. So it's not obvious that there's a sort of wage-driven underlying inflation pressure there. So it looks like we have to wait till next year for the BOJ to move, which would frankly be consistent with their behavior over the last couple of decades, where they're sort of always very, very late to hike rates.
Cameron, Katie, both of you, thank you so much. Still with us, Robert Tipp and Joanne Feeney. Robert, how much are you watching, in particular, the Bank of Japan, even if they aren't going to necessarily do anything next week, any of their communications about what the abandonment of yield curve control and negative rates could mean?
Yeah, absolutely. All the markets are a potential opportunity for us in global bonds. The Japanese situation is amazing in that the biggest risk when you get in an aggressive policy stance of, say, sustaining a long-term interest rate at a zero target is how do you get out of it without breaking anything? And the Bank of Japan has done a great job of kind of the back and forth of we may need to do this, we may need to do that, get the market kind of loosened up and then inching policy along. When they widened the band from 10 basis points around zero to a quarter, now they've gone all the way up to a soft target at 1%. And lo and behold, the 10-year JGB, after rocketing up towards 1%, rallied all the way back down to 60 basis points practically, got close to that, is now right in the middle of that range. So the key thing for central banks these days is they want time, they want optionality, and they are buying themselves time. The markets are waiting with them to see how the data goes by and large. The one market that is not waiting, though, is the currency market. And the yen has been under pressure, and that is driving inflation in Japan. So I think if there was going to be something that pulled forward their actions on monetary policy, it would be weakness in the currency. Right now, there's not enough of that to force them to pull their change into this year, it looks like. But next year, it feels like the heat is going to be on for them to inch the short-term interest rate higher.
Which is sort of interesting, Joanne, especially as we're talking about moving in the exact opposite direction of the Bank of England, the ECB, and the Federal Reserve. Just real quick here, Joanne, who do you think is going to lower rates first, the Fed or the ECB?
I'm not even going to hazard a guess because it's going to be so dependent on what's happening within the economies. I mean, we seem to have greater strength here in the U.S. given our job market and the tightness and the participation rate. So I would suspect that we have the U.S. has more time at higher rates than Europe or Japan does, given the sluggishness in some elements of those economies. I mean, we've already seen pullbacks in some sectors of the U.S., and now we're seeing recovery in those sectors like smartphones, like PCs, for example. So we've bottomed out a little bit in some areas and now are seeing recovery. So that suggests our rates are likely to stay higher for longer than in those other regions, Lisa.
Joanne Feeney, Robert Tipp, both of you, thank you so much. Good luck this week and heading into the end of the year. Coming up, the morning calls, and later, Morgan Stanley's Mike Wilson expecting earnings to get worse before they get better. That conversation still ahead as we see a bit of softness ahead of the open.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Time now for our morning calls. A look at some of the analyst recommendations this morning. First up, Wells Fargo upgrading Snap to overweight, expecting growth to accelerate after recent leadership changes. Next up, RBC upgrading Pinterest to outperform, highlighting an improving outlook for the advertising industry. And finally, Citigroup upgrading Nike to buy, pointing to an attractive margin recovery play within a choppy macro environment. Perhaps we'll get a better sense of the retail environment on Thursday when we get those retail sales. Coming up, Morgan Stanley's Mike Wilson seeing near-term risks to earnings. That conversation coming up next.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
seconds to the opening bell, no drama, just a bit of softness after 6 straight weeks of gains. A real massive year of gains so far on the S&P and the NASDAQ, almost 40% on the NASDAQ. We can see a bit of softness as we see outside of stocks, yields creeping up. Maybe this is what people are looking at as they're nervously awaiting CPI tomorrow, the Fed on Wednesday, retail sales coming on Thursday. 10-year yields up, retracing some of the gain from earlier, up 4 basis points. Euro a bit softer versus the dollar, 107.48, really no drama. Crude lower just a touch by 0.25%, $71.05. Again, we're not necessarily seeing a lot of action, and it's no wonder given all of the events stacked up in this December week. One stock to watch at the open, Macy's, the department store operator, receiving a $5.8 billion buyout offer. Joining us with more is Bloomberg's Abigail Doolittle. Abby.
Hey, Lisa, and the stock is absolutely soaring on this news, up more than 14%, heading to the best day since November of 2022. Investors cheering the fact that the beleaguered department store, and I say beleaguered because, of course, we have high interest rates. The question of consumer spending has been a big one. The recent reports have had issues. While the last one was better than feared, it still is not the strength that this department store had years and years ago, especially also as the online world comes into play. So in terms of this bid, it is $5.8 billion, as you mentioned, coming from Arc House Management and Brigade Capital Management. This, according to people with knowledge of the matter, asking to not be identified. Apparently, this group thinks that a turnaround could be executed better if Macy's is private. And of course, CEO Jeff Gennett, he is leaving in the spring. So it's sort of a clean break if it were to happen. Now, we do have Morgan Stanley saying that the share offer, $21 per share, is a little bit low, but JP Morgan notes that the investor group said that upon due diligence, they may be willing to raise it. The stock is pretty close to that $21, Lisa, suggesting that some investors think that this may, in fact, happen.
Abby, thank you so much. Sticking with deals, Cigna ending its pursuit of Humana and opting to increase its buyback plan by an additional $10 billion instead. Katie Greifeld has more. Katie.
Yeah, Cigna shares currently soaring at the moment after dropping its bid for Humana. Now, it would have been one of the biggest deals of the decade, creating a $135 billion giant. But according to people familiar with the matter, while you had the two sides agree on strategy, Cigna ended the discussions after failing to agree on price. Again, according to reporting. Now, this was a hurdle made higher by the fact that since news of the merger talks were announced, Cigna shares had dropped significantly. So that is one element boosting the shares today, the fact that this bid is ending. The other, as you mentioned, is that Cigna is planning a, quote, significant increase of its stock buyback, committing an additional $10 billion to that plan. That was according to a statement yesterday. Now, that buyback, it increases Cigna's total share repurchase authority to $11.3 billion. Cigna expects to repurchase at least $5 billion of common stock by the end of the first half of next year. You added together Cigna shares currently up almost 14%, on track for its best day in several years, Lisa.
Katie, thank you so much. Some changes coming to the NASDAQ 100 prior to the opening bell on December 18th. DoorDash is in, while JD.com, Lucid Group, and some others are on their way out. To outline it all is Bloomberg's Ed Ludlow. Ed.
Yeah, good morning, Lisa. Another name that's on its way in is MongoDB alongside DoorDash. Those names that will be included moving significantly to the upside. You see there on your screen, DoorDash up 1.5%, MongoDB up more than 2%, JD.com, Lucid, and Zoom all departing. And as you pointed out, these changes effective pre-market next Monday, which is Monday, December 18th. The one piece of key criteria in inclusion in the NASDAQ 100 is a daily average trading volume of 200,000 shares. But once you're in, there are lots of benefits. For one, prestige, right? On Bloomberg Technology, we refer to the NASDAQ 100 as kind of the proxy for the technology sector because it strips out financials. And if you extrapolate out to the NASDAQ more broadly, there's all kinds of things in there. So when you're looking at higher multiple software names and some real true tech names, it's a good place to watch. You get exposure to higher equity trading volumes, and then you're kind of surrounded by your peers in that sense. Also access to a lower cost of capital. The NASDAQ 100 year to date as well is up more than 47%. Compare that with the S&P 500. It's an interesting gauge in isolation of how some of those technology shares are doing. A curious one that's also been included is Splunk, which is subject to acquisition, as you guys know. But two names moving to the upside here. DoorDash 1.9% higher, MongoDB 2.9%. This is part of the annual shuffle. We do love a shuffle at this time of year, Lisa.
Thank you so much, Ed. We're also watching shares of Occidental striking a deal to buy Texas shale driller Crown Rock for roughly $12 billion. Alex Semenova has more. Alex.
Well, good morning, Lisa. Merger Monday is back, at least for now, with Occidental Petroleum set to buy Crown Rock. That's a large privately held shale driller in the Permian Basin in western Texas. Now, the cash and stock deal is expected to close in the first quarter of 2024. That's subject, of course, to regulatory approvals. This is according to a statement from Occidental. The company plans to finance the deal by taking on $9.1 billion of new debt and issuing about $1.7 billion in new shares. Shares are moving slightly higher now at the open. They were down as much as 1.5% in pre-market trading. Now, the deal is the latest in a wave of consolidations in the U.S. energy sector, and particularly in this region where Crown Rock operates. It's the most prolific oil basin in the U.S. This agreement between Oxy and Crown Rock comes as oil executives face growing pressure to keep buybacks and dividends flowing as growth in the sector slows. Now, interestingly, Lisa, in the run-up to this deal, Occidental's corporate jet flew from its headquarters in Houston to Omaha, of course, the home of Warren Buffett. As we know, Berkshire Hathaway is the largest shareholder in Occidental Petroleum, and the advisor on this deal, Lisa, is Bank of America Securities.
Thank you so much, Alex. Morgan Stanley's Mike Wilson weighing in on the year ahead, writing this, quote, "We see earnings risk persisting in the near term before a broader recovery takes hold as next year evolves." Morgan Stanley has a 4,500 price target for 2024, among the lowest estimates thus far on Wall Street. I am so pleased to say that Mike is joining us now with more. Mike, what makes you, yet again, bearish on a year when everyone else is finding a lot to be bullish about?
Well, look, I think it's really more about the stock picking, which is really what this year's been about too. The average stock has not done particularly well. It's been a strange year in that regard. Our earnings forecast for the average stock has turned out to be, dead right, and same thing for the average stock. And then we've had these, 10 or 20 or 30 stocks which have done extremely well, and they've done an incredible job of cost cutting in particular, which has driven the major average, the S&P 500 earnings up in a way that we did not project. And that has been the difference. And we think that that dynamic will probably persist next year, at least for the first 2 quarters, meaning smaller, lower quality businesses are going to continue to struggle. And then maybe by the second half of next year, when we see actually inflation bottom, ironically, that's when the earnings will come back. And I think that's been the trick. I mean, if you think about this year, inflation's been coming down, which usually is unequivocally good for bond yields. It's also good for disinflationary assets. It's not good for inflationary assets, which are basically small cap stocks and generally average stock. The average stock does better when inflation is actually accelerating. And I think that's been the trick this year. And most people got it wrong, quite frankly, because there were many, many people recommending, small cap stocks and financials and cyclical stocks, and those just don't work when inflation's coming down.
Mike, what you outlined, though, raises a question about the 4,500 target on the S&P at the end of next year. Is that assuming the big tech can't keep leading, that essentially there might be a recovery of some of the other stocks, the smaller caps, but that there will be at least some stasis for the big tech names that account for the lion's share of a lot of indexes?
Well, that's right. I mean, basically, this year has been all about multiple expansion, and this is in a year also when rates have gone up for most of the year until recently. So that's a combination that is unusual, as you know. So, our call at the beginning of this year was that rates were going to rates had normalized, quite frankly. They were going to continue to normalize, and then therefore multiples should normalize. So the real difference between our price target this year and what's transpired has been all multiple. We thought the market would close the year at 17 times earnings, which seems to be a fair multiple in an environment with 10-year yields north of 4% and some sort of level of risk premium. But instead, multiples are 19 and a half times. So all we're saying, Lisa, is that multiples will adjust this year. Earnings will be fine still for those large cap companies, but the multiple offset probably has them churning in place. And there will be some, obviously, that can continue to deliver better earnings growth, but it won't be all of them. It won't be as broad because that cost-cutting story isn't going to be as easy given the tougher comparisons on that front in 2024.
One reason why people are getting increasingly bullish, led by Ed Yardeni, who's gaming out 6,000 by 2025, is that yields are coming in. People do think the Fed's going to cut, that we are seeing rapid disinflation, and that this is all happening without material weakness, that we actually are seeing a normalization, a transitory, that nobody wants to say the T word. How much do you have to see more to be convinced of that kind of argument, giving a tailwind to all stocks, including those that seem to be at pretty high multiples?
Well, the reality is that we're still out of supply of labor. It's going to be very challenging for us to see a acceleration of growth. We could see a flattening of growth, and that's basically what our economic forecast is, a very unexciting economic backdrop next year, call it 1 to 1.5% GDP growth. You know, it's interesting, you know, not to pick on Ed, but I mean, I don't remember Ed talking about fiscal spending the way it's been this year. Nobody did, including us. And that has been the story also of 2023, which has buoyed a lot of the economic data, which ironically has then hurt margin pressure. So, you know, I think 2024 is going to be a year where fiscal spending normalizes, monetary policy normalizes too. We may see some interest rate cuts, and there absolutely will be a transition for businesses that have already gone through that pain. The question is, can it be broad? Can it be in a way which takes, you know, multiples higher again, or at least keeps multiples where they are? If you were to ask me, in a broadening, healthier economic environment, multiples will come down as earnings normalize, right? I mean, you're not going to pay, you know, a 19, 20 multiple on numbers that are now higher. So we do have a very bullish view on earnings for 2025. We have $266. Okay, should I pay a 20 multiple on that after you've already seen the recovery in earnings? I would argue no, and I think that's going to be the trick in 2024 is balancing, once again, multiples with where the earnings growth is better and where it's worse. And it should broaden out. It should turn into a broader market, but we think that's a second half story, not a first half story.
We were talking about this with David Balin of Citigroup, where he was saying that he expects a slowdown in the first half of the year, and then that should lead to a speed up, a growth cycle that he sees as starting in the second half. And I'm really struck by this idea, can you bet on the growth that you are going to see by buying those shares that you think will win in the recovery before we get the downturn? Do you feel like we could buy small caps now, smaller stocks that have not necessarily participated as much, in anticipation of what will happen maybe 6 months from now?
Well, no, we would share that view, meaning we think it's too early. It's premature to be, you know, kind of going down the quality curve. In fact, we wrote a note again this morning about that very feature. There's the number one question we're getting from clients right now, Lisa, is can the market broaden out? Should I be buying small cap stocks, in particular lower quality, you know, businesses because they've underperformed so much? And it's under the guise of, well, the Fed's going to be cutting rates. Isn't that going to be good for small caps? And we've done the work on this, and the answer is unequivocally no. When the Fed is cutting interest rates after a hiking campaign, typically small caps continue to underperform into the rates cuts, and then even after they cut rates, because you need to finish the cycle. You need to, you know, sort of have that finishing move, and we think that could be, once again, probably the next, you know, 6 to 9 months of the year, first part of 2024, where we're going to continue to see quality outperform, kind of large cap defensiveness do better. Okay, it's not going to be as good as it was this year because you've already had a lot of that performance, and it's really going to come down to idiosyncratic stories. That's how you're going to make money. It's picking stocks. It's not, you know, making a big market call. And it's being very disciplined around kind of revision factors and what you pay for those revision factors.
Just to put a narrative around this, are you basically saying that we're reaching the end cycle, and the next 6 to 9 months will be the end of the cycle, and then a new one will start after that?
It's going to be one of the, I mean, yes, it's end of cycle, and that means one of two things. It means a hard landing, or it means that we're going to have some new exogenous shock or driver for positive growth. Okay, the kind of status quo of decelerating growth, falling inflation typically is not good for equity. So the no landing scenario was always kind of a fantasy. Okay, it has to be one or the other. It has to be either hard landing or it has to be a reacceleration of growth. And, you know, right now, the first half of the year probably feels more like a hard landing still. And then maybe in the second half we can get a broadening out. And I think that broadening out, that positive driver, exogenous driver of growth will probably come from global growth. And that's really another place where we think opportunity could be broader.
Right now, heading into year end, what's your number one pick? 30 seconds.
Well, number one pick is still to kind of stay up the quality curve because it's, you know, the last 2 weeks of the year. So first of all, this week, I think it's important to understand we're going to have a Fed meeting that's critical. We've had a huge rally in bonds, and we may give some of that back. And if we were to give some of that back, then we'd probably give back some of the equity returns. So this is not a time to be chasing. January will be a better month for that, you know, opportunity to kind of put money to work into equities. I'd say the next 2 weeks is going to be more about rates, and rates probably go up the next week or two.
Mike Wilson, thank you so much for being with us. It's always wonderful to speak with you. Coming up, a $5.8 billion buyout offer for Macy's.
It's not the first time we've seen Macy's go through a takeout. You know, Hudson Bay tried it a few years back. Starboard tried it back in 2015. So we're still gathering news.
Macy's receiving a multi-billion-dollar buyout bid as Cigna walks away from talks with Humana. That conversation coming up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. We don't have the luxury of saying we can temporarily stock out on our product, because these products, these medicines keep people alive.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
It values at around 4 to 4.5 times EBITDA, which does look pretty low when you look at historical deals and takeouts for the retail space, which can really vary anywhere between 6 to 10 times. It's not the first time we've seen Macy's go through a takeout. Hudson Bay tried it a few years back. Starboard tried it back in 2015. So we're still gathering news. I'd be interested to see what the strategy is by these two firms outside of the real estate, which is really the underpinning asset here.
That was Gordon Haskett analyst Chuck Grom weighing in on a potential Macy's buyout. According to sources, Macy's receiving a $5.8 billion offer from real estate investor Ark House Management and asset manager Brigade Capital Management. News of the offer breathing life into the retailer stock after last month's report of a 7% sales decline in third quarter sales. Here with more is Bloomberg's John Edwards. John, what's the latest in how feasible this potential buyout is?
Yeah, well, we're still assessing that, but the market seems to think that there is something to it. It's very possible that after due diligence, they come back with an even higher offer. We'll see how that sort of transpires here. But the thought is that the Macy's sort of turnaround plan is actually making progress. But these investors think that they can make even more progress sort of out of the glare of the public markets.
Is there a sense that private markets are going to be a better, more forgiving place for a company like Macy's that's faced a lot of activist potential activity?
Yeah, I mean, certainly more forgiving. You get out of the sort of quarterly cycle, ups and downs. Actually, despite that same-store sales decline, the third straight in the most recent quarter, the stock did do pretty well on that report because their inventory management was seen as getting better. But to take it away from the ups and downs, to take it away from the excess attention and just sort of focus on executing that turnaround, without worrying about the markets. That's the idea, I guess.
John, thank you so much for that. Turning now to healthcare, Cigna calling off its massive deal with Humana, thanks to price friction, which is a nice way of saying they didn't like how high the price was. The company putting an end to what would have been one of the biggest deals of the decade, now adding $10 billion to a stock buyback plan instead. Back with us, I'm so pleased to say, Katie Greifeld. Katie, to me, this really is what better use of cash at a certain point, if you don't like the price, than just buying back your own shares.
Yeah, and indeed, you had Cigna's CEO saying that they believe that the stock is, quote, undervalued, less so today. Of course, shares flying. That additional $10 billion gives Cigna total repurchase authority of $11.3 billion. That's one element. The other element, of course, is dropping the bid for Humana. JP Morgan pointing out that while it made sense, the longer-term merits of that deal, a prolonged review process, that would have been a negative. Meanwhile, you have Jefferies upgrading Cigna to a buy, writing that Cigna's decision to drop the Humana bid is, quote, doing right by shareholders. You can see traders definitely agree. Cigna shares flying right now, on track for the best day since November 2020, Lisa.
Katie, thank you so much. Let's take a look now at some of the price action in specific sectors. Let's head over to Bloomberg's Abigail Doolittle. Abby.
Well, beneath the very benign surface for the S&P 500, that's down fractionally. Not too much drama, as John would like to say, Lisa. We have industrials leading the way, up about 0.7%. To the downside, a little bit more of a laggard out of communication services, down more than 1% on Alphabet, lagging. Utilities, interestingly, also down 0.2%, because we can see down on bottom are a lot of the tech sectors with yields higher, but yields higher and that actually does, excuse me, I'm thinking live on air, does make sense that utilities are down too, because those dividends look less attractive. On the monthly, so let's take one sector that is flying high, excuse the pun, and we might actually be going all the way back to the beginning of November. We are up 25%. The airline's a strong recovery. This, of course, as oil has gone down sharply, creating some cost-cutting potential for these airlines.
Abigail, thank you so much. We're also hearing about record travel plans for the holidays. So just looking to exceed what we saw in 2019, also potentially giving a boost to some of these airlines. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. And oh my goodness, what a busy week. The busiest, most important week to end the year. This is Bloomberg.
The reception, the acceptance of Puro Sangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Puro Sangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So a 250,000 cars in a market where there are million and million of cars every year.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
25 5 minutes into the trading session, you can see that sogginess persists, at least in the S&P, although not so much with the NASDAQ, up about a 0.25%. What you can see is fueled by a sense of calm in the bond markets, in currencies, and in oil. Time now for the trading diary, what you need to be watching this week. Tuesday, the latest U.S. CPI print, plus the U.S. selling $21 billion in 30-year bonds. Wednesday, U.S. PPI numbers, plus we'll get a Fed rate decision and Chair Powell news conference. On Thursday, it's the ECB's turn, along with the Bank of England as well as the Swiss National Bank, all trying to deal with the one question: when can they cut rates and how far can they cut them if there isn't necessarily some sort of weakness and if inflation is lower, but not to the level that they wanted to see. Right now, we're looking at yields marginally higher, but way off the highs, north of 5% just a month ago. This was Countdown to the Open. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Brad Jacobs, Executive Chairman of XPO Logistics, joins us to discuss. He's got a new company. He's going to be going out there and rolling up a new business, a new industry. He's going to tell us what he's up to next. He did it in the logistics space. He's moving on to something new. We're going to get the latest on that. Plus, we're going to check in with Scarlett Fu. We're going to talk about the business of sports, major headlines this week, including Live Golf's latest and Shohei Ohtani's record contract. So the Scarlett Fu on the business of sports. And then Ethan Devitt, CIO at Medetta, is going to join us to give us her market call. But first, let's check in with Nathan Hager and get a Bloomberg Business Flash.
All right, we'll get right to the numbers, Paul. We check the markets all day long here on Bloomberg. Right now, the S&P 500 is little changed to the upside. 4605 is the S&P level. The Dow Jones Industrial Average is up 0.1%, up 35 points, 36,281. The NASDAQ Composite is down 0.2%, down 28 points, 14,375. So not a lot of movement at the index level. Investors are kind of holding off on making big bets before we get the big economic data this week, the Fed's rate decision on Wednesday. The bet from Brian Levitt, global market strategist at Invesco, is peak rates are here.
We're now in a position where the Fed funds rate is likely to be quite a bit higher than what the nominal growth is going to be in this country. So they're at the end of the tightening cycle. They're not going to signal it. They're not going to ring a bell because they don't want financial conditions to ease too much.
Right now, 7 of the 11 main industry groups in the S&P 500 are in the red, led lowest by communication services. Industrials and consumer staples are the biggest gainers on a flat S&P 500. 10-year Treasuries down 10/30 seconds, yield 4.26%. The 2 years at 4.75. NYMEX crude is down 0.4%, trading just below $71 a barrel at $70.96. COMEX gold is down 0.6% at $2,001.70 per ounce. The euro trades at 1.0751 against the dollar, the British pound at 1.2563, and the yen is at 146.29. That's the Bloomberg Business Flash. Bloomberg Markets is on with Paul Sweeney.
All right, Nathan Hager, thank you so much. We appreciate it. The John Tucker in studio with me for the next 3 hours.
Because basically they went out in the newsroom, who wants to co-host with Paul?
Exactly.
And nobody raised their hand.
Nobody raised their hand. So there you go. You got the short straw. So we got John Tucker for the next 3 hours taking care of us. So that's good news. Hey, John, looking at this news here, because, I mean, Matt Miller says he needs these weight loss drugs. And the dude 6'4", weighs maybe 200 pounds, does not need them, but he's out there saying he needs it. Anyway, the story today is people who stopped taking Eli Lilly's Zepbound after about 8 months regained half the weight they'd lost a year later, yet were significantly thinner than when they'd started the obesity drug, according to a study. I don't know. Is that good news? Or
so what does it signal? That you have to stay on this thing for life, basically?
I kind of
Or at
think
least
so.
until you change all your habits?
I don't know. It's just a crazy thing. But this thing's going to get out of control very quick. Once they put it in the pill form, people are just going to go nuts for this thing, I think.
And then combine this with, I don't know, artificial intelligence.
Right. what could go wrong? And then some gummies, and then you can put it all there, and then there you go.
Don't go there.
Exactly. All right, looking at this market, really no real movement here on the index level. S&P really pretty much unchanged on the day. But let's check in with Abigail Doolittle. She looks under the hood for these markets and give us some good company moves and some good trends there. Abigail, what are you looking at?
Well, that S&P 500, to your point, really not moving at all. Fractionally lower, fractionally higher, fluctuating at this point. Interestingly, though, it's doing on above average volume, so more stocks are trading to nowhere at this point. The SOX is outperforming. That chip index up 2.4% over the last 3 days. It is up 5.9%, the longest winning streak since essentially almost in a month or so. And to John's point on AI, well, a lot of these chips are booming on the AI trend. Relative to yields, up a little bit. You know, the big headline this week, I would argue, is the FOMC on Wednesday, largely expected to do nothing relative to actually moving rates, but it's the color everybody's going to want. And I personally am going to be really interesting to see if in the press conference in some way, or even in the statement somehow, but if in the press conference, Fed Chair Jay Powell pushes back on those who are calling for an informal Fed pivot, that cuts are going to be happening early next year. Because I personally don't think that I haven't heard him say that once at all. And if support for yields breaks from here, you're going to see that 2-year yield go below 4%. Is that what the Fed wants? So I'm going to be really interesting to see if he pushes back.
Oh, I get some breaking news here, just crossing the Bloomberg terminal. Goldman, I've never seen this word in a Bloomberg headline. Goldman rejigs. The private credit management aims to double its assets. Goldman Sachs, ticker symbol GS. I don't see any movement on the stock there, but just bringing that breaking news to you.
I didn't know that was a word. Isn't it rejiggers?
Well, yeah, you're right.
Now.
It's in the Bloomberg. It's in the Bloomberg headline. There we go.
It's now a word.
It is now a word. We'll have to check in with things. I mean, here we had that great move, Abigail, in November. A little bit of continuation in December here. I mean, what's the street saying? Did the market get a little bit ahead of itself in November?
I think most strategists think that the market did get ahead of itself in November when you think about the relative uncertainty out there around Fed. The assumption, similar to what I was just saying, a lot of strategists on the streets have not heard the Fed talk about a pivot, and yet markets are pricing that in. From a technical standpoint, the market, the S&P 500, having a really hard time getting above resistance. That's true for the NASDAQ. That's a fancy way of saying that the sellers are pretty relentless at certain levels. They don't want to let the buyers push stocks higher. There's going to need to be a good reason for it.
Hey, what happens at the end of the year? Explain to everybody the dynamics where you got to make your numbers. I don't care what the Fed is doing at this point. It's just December 31st. It's quickly approaching.
Yes, and I think we're probably seeing some of that now, although it's not really, again, influencing stocks so much today, but managers are thinking about what their returns look like. They're thinking about tax law selling. So there are a lot of other factors that go into dynamics for this month. And certainly at the end of the month, one question about the end of the month will be, will we get that Santa Claus rally, which I believe it's the last 3 or 4 trading days and then the first 2 days of the following year. Seasonally, December is supposed to be a good month. Right now, it just kind of feels sort of meh. And I would say a piece of that is we've had stocks in a range, up and down, uncertainty, a battle between the bulls and the bears. And until one side has enough information to convincingly go up and out of the range or back down into the range and possibly below it, we're just kind of stuck here. I would say that that's sort of why we're.
And we had some more bullish calls as well. John Stolfus among them, 5,200 for the S&P 500, his target.
And
that would be for what, next year, though?
That would be for next year. So that must be a street high because as of last week, Deutsche Bank and Bank of America were at 5,100 as the street high. And then we, of course, have JP Morgan's Kalanovic at the low of 4,200. I would say we could very easily see that 4,200 before we see the 5,100. That consolidation would create the base to then create a move higher. So that's a big way, a long way of saying strap on your seatbelts for next year.
Ed Yardeni, 6,000 in 2 years. In 2 years. In 2 years.
Oh, in 2 years.
Yes.
Okay, because
this is according to Market Watch. Yeah. So
okay,
2 days.
Question: how do you project? I mean,
you do what I did for 30 years.
But how do you project?
You do what I did for 30
out?
years. You put an earnings estimate out there. You slap a multiple on it, and you go and market the heck out of it. And you make a career out of that. Very good. Abigail Doolittle, thank you so much. We appreciate it. Abigail Doolittle covering all the markets for us. All right, he's back, folks. He said he'd be back, and he's back. Brad Jacobs, Executive Chairman of XPO. You know it and love it on the New York Stock Exchange, XPO. He's got a new company, which he's been talking. I guess he kind of hinted at the last time he was here. Teased. Thank you very much. Brad, thanks so much for joining us. We really appreciate you coming back. Talk to us about the new opportunity you've seen. I mean, you've done roll-ups of the waste management business, the rental business, the logistics business. Now what?
Building products distribution.
Building products distribution. Okay.
So if you think about any house or a commercial facility or a hospital or a school or a church, all the stuff that goes into making that building. So that could be the roof, the flooring, the windows, the tiles, the doors, the fire hydrant, the infrastructure, the pipes, HVAC. All that stuff has to go through the supply chain. And it's huge, huge markets, $800 billion in size between here and Western Europe. And it's been growing about 7%.
All right, so what do you bring to it that's new?
We'll bring a lot that's new. First of all, we're going to create a very large company and get all the advantages of scale and size that come with that. Second of all, we're going to apply technology. We're going to apply technology, especially AI, for dynamic pricing, for managing the warehouses better, making them more automated, to do route optimization for the delivery trucks, to do interactions with the customer. E-commerce right now is mid-single digits %. It should be the majority.
And in building materials, Paul, all I want is a straight 2x4.
I know, that's...
Can you make that happen?
It's
a big deal.
You got it.
No, it's a big deal where you source your materials, because even though it's commoditized, I just find as the end user, it's not always the same product.
Well, I'm glad to hear that there's a problem to solve in this chain, and we will solve that.
Talk to us about kind of the, I guess in the past, part of your strategy has been rolling up a fragmented industry. Right. Is that in fact the case here? Talk to us about kind of the fragmentation and kind of how you plan to deal with that.
So there's about 13,000 distributors here in the United States. Excuse me, 7,000 here in the United States. It's about 13,000 in Europe. So there's 20,000 distributors between here and Western Europe. So it's very, very, very fragmented. The largest company would be Ferguson. It's about $30 billion. Great company, done very, very good, very well. But I plan to make a company even bigger than that.
Boy, I'm going to be... How do I invest in this one? I'm not going to miss this one.
Well, as Paul, it's not your first rodeo. What is the experience that you picked up at the other companies with which you were involved, and how does it apply to this?
Well, it's a similar business plan in the sense that it's going to be primarily based on consolidation, acquisitions, so acquiring companies at a relatively good price, a price that's a lower multiple than what we're trading at, and then improving those companies. So if you look at XPO Logistics, for example, we bought 18 companies. They were doing roughly $1 billion in EBITDA between all of them. And after a few years, they were doing over $2 billion of EBITDA. So we improved the companies that we bought. That's the same thing we're going to do here.
Do you become then a friend or enemy or a frenemy of Home Depot or Lowe's?
Home Depot, and to a lesser extent Lowe's, plays in a specific niche of this market, mostly the pro contractor. And they'll be one of many competitors, 20,000 of them to be precise.
Okay. All right, so I know we were talking to you the last time, management teams, assembling a management team is one of your primary responsibilities, jobs.
The most important thing.
Most important things. Talk to us about how you're going to kind of do that here.
So I wrote a book, as you know.
Yep.
And it's called How to Make a Few $1 Billion. And the key thing, if you read that book, is the quality of the people. Make sure you have people who are really smart, really hardworking, very good at what they do, collaborative, good team members, people who are really sharp and focused. And if you can get that quality of world-class management hired, and if you can create a culture where everyone values the relationships between each other and treats each other with respect and transparency, you can accomplish a real lot. I'm going to have that same exact principle here. That's one of the most important principles for success, in my opinion. And by the way, we named it QXO, Q for quality.
Yep.
We kept the X and O because we're going to use some of the same winning principles that made XPO and GXO and RXO successful.
How far behind is the building supply industry in terms of adapting and using technology?
As an industry as a whole, it's behind. Maybe it's in like the second inning. There are a handful of companies doing pretty well. So last week, Builders First Source had an investor day. I read the transcript and saw it on webcast, heard it on the webcast. I like what they said about what they're doing in technology, but they're the exception, they're the anomaly. Most companies are not using technology in any big way in the warehouses. Most of them are not using technology enough on the route optimization. Most of the building products distributors are not using technology enough for pricing decisions, for pricing optimization. And these are big variables that can enhance the customer experience dramatically and take out lots of unnecessary cost.
Well, does this mean you pass the costs on to the end users?
To the contrary, I hope we save money for the end user because we're going to take out waste, take out inefficiency in the whole supply chain, and we'll share that. We'll share that with the customer. We'll have better margins, but we can share some of that improved margin with the customer.
What kind of revenues are you predicting at this point?
By the end of the first year, we should be on a revenue run rate of at least $1 billion. At the end of the second year, we should be on a revenue run rate of at least $5 billion. Whoa. And over the next decade, we expect to get this into the tens of billions of dollars in revenue size.
So where are we with QXO now? Press release comes out today. Where do you start? Where does your capital come from? How do you go from here? How do you build this company?
Well, I was on your show last week, and we talked about how we're putting $1 billion of equity into a very small cap company called Silversun.
That's right.
And we're going to wait till that deal closes in a few months, and then we're going to spin that company back to the original legacy shareholders. Okay. We're going to give them a little dividend, $2.5 million. We're going to give them a less than 0.5% share in our new company. Okay. We'll have our new company, we'll own over 99% of it, and we will use that money to go out and do some acquisitions and start building the business. And over time, we'll tap the capital markets as we've done over the decades.
How do you typically fund your deals, equity versus debt, given now that the debt is so much more expensive than it was over the last 10, 15 years?
More equity than debt than in the past. In the past, I've been comfortable going up to 2 to 4 times of leverage. Here, I'm thinking more, roughly half of that. And the reasons are twofold. One, as you said, interest rates are higher. Although 20 years ago, interest rates were right here.
Yeah.
It's just recently, it was in the last 10 years, they got almost to nothing. Secondly, is the world has a lot of macro issues going on, wars and geopolitical tension, and it's more prudent to have less leverage, in my opinion.
What's your title going to be? What's your role in all this? And are you giving up your other businesses?
I'm certainly not going to give up my other businesses. I'm executive chairman of XPO, and I plan to keep doing that. And I'm non-executive chairman of RXO and of GXO, and I love all 3 of those companies dearly. And I think I help them in the roles that I play there. In terms of what my title and position is going to be here, it's going to be the same title I've had since I've been 23. I'm going to be chairman and CEO, and I'm going to run the company. I'm going to lead the management team.
And what made you target this industry specifically? You've got about 30 seconds or so left.
I looked at over 500 opportunities in many, many different industries. And this is the one that checked every single box of what I was looking for. Something that was large, something that was acquisition rich, something that was up my alley in terms of my skill set, something where there was growth, 7% organic growth, and an industry and a customer set that is familiar to me. United Rentals has a big overlap with the construction customers, for example.
Fascinating. Brad, thanks so much for joining us again. We appreciate you coming back and bringing us up to date on your new opportunity. Brad Jacobs, he's executive chairman of XPO. He's got that $1 million fund, which we talked about a couple of weeks, and now we know what he's going to do. He's going to go into a new business and hopefully build another successful company for his shareholders. So we appreciate getting a few minutes of his time. Looking at the markets here, pretty much unched on the day. NASDAQ off about 0.25%. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. 2 private equity firms want to buy Macy's. Sources tell Bloomberg the department store chain has received a $5.8 billion buyout offer from Ark House Management and Brigade Capital Management. We get more from Bloomberg's Abigail Doolittle.
Apparently, this group thinks that a turnaround could be executed better if Macy's is private. And of course, CEO Jeff Gennette, he is leaving in the spring. So it's sort of a clean break if it were to happen. Now, we do have Morgan Stanley saying that the share offer, $21 per share, is a little bit low. But JP Morgan notes that the investor group said that upon due diligence, they may be willing to raise it.
Macy's right now is up more than 17.5%. Well, Cigna is ending its talks with Humana and is planning a $10 billion buyback instead. Bloomberg's Katie Greifeld has that story.
It would have been one of the biggest deals of the decade, creating a $135 billion giant. But according to people familiar with the matter, while you had the 2 sides agree on strategy, Cigna ended the discussions after failing to agree on price, again, according to reporting. Now, this was a hurdle made higher by the fact that since news of the merger talks were announced, Cigna shares had dropped significantly.
Now, that buyback increases Cigna's total share repurchase authority to $11.3 billion. We'll check in with Cigna right now. They're up more than 16%. Humana down more than 1.5%. And Warner Records and Sony are suing Altice USA, the owner of Optimum Cable. The music labels claim that Altice failed to crack down on users who use its internet service for illegal music downloads. Those are the company stories we're following this hour. I'm Lisa Mateo. This is Bloomberg.
Connection lost.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
We're coming up to 10:22 on Wall Street. I'm Nathan Hager. We check the markets all day long on Bloomberg, but there's not a whole lot going on at the index level with traders waiting to make big bets before we see inflation data tomorrow, a Fed decision on Wednesday, and retail sales figures on Thursday. Right now, the S&P 500 is up 2 points. That's a little change to the upside. The Dow is up 66 points. That's a gain of about 0.2%. The NASDAQ is lower now by 39 points, or about 0.3%. 8 of the 11 main industry groups in the S&P 500 are higher right now, led higher by industrials, but communication services is a big drag on the overall index right now. 10-year Treasury's down 9/32, yield 4.26%. The 2-year is at 4.74. NYMEX crude's down 0.25%, trading at $71.06 per barrel. COMEX gold is down 0.7% at $2,000.80 per ounce. Euro 1.0752 against the dollar. The yen is at 146.38. Keeping an eye on Eli Lilly shares at this late morning hour. A study in the Journal of the American Medical Association was announced this hour. It shows people who stopped taking Lilly's Zepbound weight loss injection after about 8 months regained about half the weight they lost a year later. Eli Lilly shares have lost 2.2% at this hour. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and John Tucker.
Nathan Hager, thank you so much. We appreciate it. John Tucker and Paul Sweeney, we're live here with you in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube, so you can head over to youtube.com. That's the internet, John, and you can search Bloomberg Radio. Bloomberg Markets is brought to you today by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. All right, the business of sports, John. It's Scarlet Fu and a couple other slugs. I think Michael Barr and some guy who's an emerging markets guy, how he gets it, Damian Sassower.
He does it all.
He does it all. But they talk about the business of sports. I've got a lot of business of sports questions. I'm a golfer. I'm a fan of the game of golf. I'm a fan of the business of the golf. I don't understand what's going on with this Live Golf thing. I thought the PGA and the Live were merging. Everybody was going to be happy all together. And then John Rahm says he's going to go and take 300 large from Live Golf. Can you, Scarlett Fu, you cover all this for us. Can you tell us what's happening here?
Well, he's the reigning Masters champ, the #3 player in the world, so he has this legitimacy to going over to Live, and he's the biggest signing by far yet. And you're right, Live Golf and PGA Tour are working towards a deal, but nothing's happened yet. They have to give an update by December 31st, and it's not clear what shape this deal will take, although we do know that PGA has been talking with other investors, including a report this morning from Jillian Tan that a Fenway Sports Group-led consortium has been chosen to enter into final talks to be a co-investor, a U.S. co-investor in this Live Golf PGA Tour entity.
Every one of these sports stories, as of late, the common denominator is money.
Yeah.
And
Lots of it.
with this specific case, golfers signing with Live, something in me tells me that this is some sort of Faustian bargain that these golfers are making. Am I being too cynical or
Is it a Faustian
not
bargain,
realistic?
Though? If the PGA Tour is in active negotiations with Live Golf to merge, whatever obstacles they threw up there and whatever concerns they cited has kind of gone by the wayside. They opened the door to golfers negotiating with Live Golf directly. We know that John Rahm had said in the past that he was not interested in the money. He said he and his wife were not concerned about the money that Live could offer them. He's always been very interested in history and legacy, and he said back in 2022, right now the PGA Tour has that. Now, once it became apparent that the PGA Tour was negotiating with Live Golf, maybe it doesn't have that history and legacy anymore because it's open season.
It is. I mean, if the PGA is going to merge with Live, they're going to take a direct investment from the Saudi investment fund. So you've already lost that. The fundamental argument that the PGA had against Live is now by the wayside because you're in fact taking that money. So now if I'm John Rahm, I'm like, why do I wait?
Where are the regulators in all this? What's the
DOJ is looking into this, and again, they have that December 31st deadline with which to update the government. We do know that Jay Monahan and the PIF governor, Yasser Al-Rumayyan, are scheduled to meet this week for negotiations. So maybe there'll be some reporting out of that.
Now, independent of each other, could the PGA possibly survive on its own against an entity like Live?
I don't know. They don't have bottomless pockets like Live. Live is backed by the Saudi government.
But I'll tell you what the PGA has that Live doesn't have, which is a network television contract.
Yes.
I mean, if you want to watch Live, you got to go find it on the CW, which are a bunch of hodgepodge stations around. They have no, and so it is. I mean, I'm an avid golf fan. I will watch the second round of some tournament in Poughkeepsie if it's the PGA Tour. I haven't seen one shot of.
You could,
Live.
but you just don't want to.
It's a combination. I don't really care to. The PGA takes care of it for me. And, I don't know. So, but there's enough people that are following Live, I think, that it's a thing. And it doesn't matter what the TV contract is as long as you have, I guess, that Saudi money behind you.
Yeah, well, I mean, they can always disrupt that at some point, and technology is moving in the direction of people are not necessarily going to be signing up for the cable bundles, and signing up for CW streaming will become more and more attractive over time.
All right, so what next for the Saudi government in its investments?
I don't know, maybe the Saudi government should look into Shohei Ohtani.
Yes, so now money. It's all about the Benjamins.
A lot of money in this case.
$700 million?
Over 10 years. Wow. This is the largest contract of any in any U.S. professional sports league. It tops Aaron Judge, his contract as a free agent, 9-year, $360 million. Mike Trout, who got an extension, 12-year, $426.5 million. Even Patrick Mahomes, 10-year, $450 million. Lionel Messi, when he re-signed with Barcelona. So this is a, ball. Well, no, I didn't want to use that word.
Well, I mean,
it's a bracket-busting contract. How about that?
It's amazing. I mean, did they? What's the money behind the Dodgers? Like when I think about the Yankees, I think about the Yes Network, and they make a ton of money.
They have a very lucrative sports TV contract, media contract. But this is also the second biggest media market in the nation, right after New York. And on top of that, unlike the Yankees, they've done very, very well on the field. They won the World Series in 2020. They haven't missed the postseason since 2012.
Yeah, that's amazing. That's kind of like the Yankees of the 90s and the early 2000s.
Is he worth it?
He's worth it.
Okay, give me some stats. I don't